just as I'm watching Justin Trudeau disappear as truckers have basically shut down the supply chain in Canada. A lot of stuff going on. But we'll get you right back to the coverage that we had here last year, February 1st, from Silver Squeeze Weekend. Leave aside what's happening now and how amazing it is that it may actually blow up on the anniversary. This paper silver market is ready to break now. I don't know which day or minute it will be, but it's breaking now. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And it was this time 1 year ago today, 1 year ago, when people started realizing that the silver market has been a crime scene. And they started buying silver to expose that. All of this stuff that broke down last year that we've been tracking ever since then and trying to get answers from Ross Benham of the CFTC, Jeff Curry of Goldman Sachs, who a year ago today, this is right when they were about to make these statements and lies that they did on TV, that were on the record, that we've talked about for the last year. And amazingly, on the anniversary of Silver Squeeze Weekend, I'm sitting here digesting buying call options, not legal financial advice, but just as I'm watching Justin Trudeau disappear as truckers have basically shut down the supply chain in Canada. A lot of stuff going on. But we'll get you right back to the coverage that we had here last year, February 1st, from Silver Squeeze Weekend. Leave aside what's happening now and how amazing it is that it may actually blow up on the anniversary. This paper silver market is ready to break now. I don't know which day or minute it will be, but it's breaking now. Justin Trudeau, who's been vaccinated, who is forcing other people to get vaccinated. Disappeared for 2 days. The Prime Minister of Canada. Because a lot of people are not happy with him. The truckers have taken control of the country in peaceful fashion. And we'll get to him later tonight, because what he said yesterday, I still can't believe I heard it. And it's something that I think people need to hear. So that will be coming tonight. But to get you ready for that, this is what was happening Silver Squeeze Weekend in the year 2021, February 1st. 1 year ago today.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. What an exciting weekend it's been. A very historic weekend in the silver market as we were on January 31st, 2021, 15 minutes before the silver market is about to open after this historic weekend, which just had a panel. I think there was a consensus agreement, more attention on the silver market than ever before. And with that said, while you're watching the silver price tonight, just wanted to let people know, I know there's a lot of new folks to the channel and I appreciate you all being here. I did actually turn this whole story that I've been studying for the last 12 years. I remember there were times I wondered if it was time to do something else in life, although it was just so intriguing and I kept researching it. And actually last year turned it into my very first book, which you can see, The Big Silver Short, And this consists of interviews with 15 of the world's top silver experts. In many cases, people like David Morgan, Andrew McGuire, Bart Chilton, Rick Rule, Craig Hemke, Dave Kranzler. Basically, I sought out the most informed people in the silver world that I could find with the goal of creating something that, I mean, while I never imagined this is how exactly it would play out, that at a time like this, if you want to understand really what's going on without having to search a lot of places and it's all in one concise book, well, that is the Big Silver Short. And fortunately, it is available. It came out last year. Wanted to get it out in advance. Although if you're just catching on now, the paperback version is available. Although if you'd like to actually get it in your, maybe not hands tonight, but if you want to listen while you watch the silver market tonight, audio version available. You just click right there and you can start downloading that thing as soon as you click that. And again, I actually like the audio version. It was not some actor reading it, but the actual interviews similar to what you see on the show and talking about the leverage on the system, the Hunt brothers, the story behind Warren Buffett's silver position, on why Warren Buffett sold his silver position. Perhaps most importantly, not only just the history, but how this is going to unfold. You'll see the people, just how in The Big Short, there were the people who saw that the mortgage bubble had formed and was eventually going to pop. I wanted to get it on record, the people who saw this before it happened. And you can actually start listening before the market opens in 12 minutes. Here is the page on Amazon for The Big Silver Short, because many were stunned to see The Big Short, realized there were a few savvy traders who saw the subprime crisis in advance, use that knowledge to make a fortune in the markets. Well, I guess I'm a little bit biased here, but I like to think that this is a roadmap that will serve a lot of people well for what is about to come. And just to give you one little snippet of what you might hear if you got the audio book, fortunately, the Bart Chilton interview was so shocking when he confirmed what people for years called conspiracy theory. Yet here was Bart Chilton, part of the CFTC, a former commissioner, who confirmed that JP Morgan had the large position, who confirmed they made it bigger. At the same time, he told them to reduce it because it was over the limit. And at the same time, silver got torched in 2008, while there was a physical silver shortage, no less. And it fell from 21 to 9 as banks were failing like Bear Stearns, as the Fed was doing historic interest rate cuts, as people were buying the heck out of silver, and all these things that have led to the situation that you're seeing unfold right now. Well, it's all in here, or the audio version. And here's a little snippet from Bart Chilton. Might add, he was with the agency during the years that the Department of Justice recently found hundreds of thousands of occasions of spoofing. And just to give you an idea of the kind of stuff that is in here, we'll play a quick clip here. Again, I appreciate you mentioning the spoofing. Curious, because my understanding of how some of the manipulation has occurred is that, you know, if silver is trading $20.05, there's a lot of stop orders placed around the $20 handle. So often if the price can get pushed a little bit, then you get a lot of those high frequency algorithms kicking in, and then you'll see a drop with many feeling that people kind of nudging a little are then able to buy lower. Does that sound like a reasonably accurate portrayal to put it in perspective to folks, or would you phrase it differently?
Well, it's a good portrayal, but it's a very good portrayal.
And then he explains the mechanics of spoofing for about 3 minutes before summing it up with.
So the difference in your description is that today, when a market moves because of a spoof, it can move a lot more.
And certainly we have seen that. In fact, on the back cover here, you can see that incredible chart from April 30th, 2011, when silver fell $7 in the middle of the night as QE2 was raging on. And if you want to know what was the story behind that and a whole lot more, well, then, like I said, click in the link in the description field below. to go get your copy of the Big Silver Short now. Get it in audio, and you can actually start listening while you watch the silver market with whatever it has in store tonight. So with that said, hope you're having a great weekend out there, and I think you will like this book. To all the silver investors who kept the faith, in some cases for 40 years, for longer, for the people who thought that silver was manipulated and took a lot of crap for it for a long time. Wow, what an incredible weekend, and welcome on in to Arcadia Economics. I'm guessing we may have a few new faces here where I've attempted to create the ESPN of the silver world. So for everything that's going on, we will have you covered this week, and God only knows what could happen next. But as you can see here on the Kitco chart, silver up $2.14, almost 8%. Keep in mind that the Kitco chart will often diverge from the futures chart. So here you can see, as has been the case since last night, bid-ask spread on Kitco showing up $1 wide. So I would say really if probably a more reliable gauge, here is the futures contract over on investing.com. And you can see it did cross 30 a couple times last night, which you can believe rather than sleeping. I was up looking up the last time that happened, I believe was in January of 2013. So goodness, what a historic weekend and set of events. Obviously, I don't know if it started last week. I mean, it started decades ago, but maybe the bubble, the pin to pop the bubble that we've all waited so long for began with short squeezes in a bunch of stocks like GameStop and AMC and others. And then they started noticing, wait a second, there's this stuff silver here that looks kind of juicy. And fortunately, that's what we cover here, because a lot of folks have been seeing this building for years, very similar to the housing bubble. Although, when does it end? Sometimes you just find out when you find out. And I think we're in a transition to the ending now. After what I saw this weekend and what's happened, keep in mind, this only with the Wall Street bets, because only trading days started Thursday. Saw silver spike Thursday, spike Friday, and then last night after the dealers. To be clear, I know there's going to be a lot of questions about the dealers, because by Saturday night, interestingly, we were doing a webinar on this Saturday and had quite a crowd, and then we start seeing dealers put up notices that they do not have silver available for sale. Now, to clarify what's going on there, the dealers did not run out of silver. There's not technically a dealer shortage, but what they had hedged going into the weekend, that was taken out. So a lot of the dealers were not able to hedge their metals, and most of them are back up and running now. You can check. I know Miles Franklin is up and running, so if you have questions or want to place an order, Arcadia at Miles Franklin, keep in mind they're getting swamped right now, so please be patient. If you want to follow up with a gentle reminder email a couple hours later, just imagine everyone in the world is going nuts and nobody knows. I don't think nobody knows what's happening, but it's a bit chaotic, so patience is appreciated, but we are trying to help as many people as we can right now. There you see the futures contract up 290. Good God, is that beautiful to look at. I have some screenshots from last night when I was trying to sleep and just couldn't for a while, where you actually saw it up over $3. And I was thinking, gee, I don't remember, it's like we've seen it down $3. I mean, I still remember clear as day when we saw it plummet down $6 on April 30th of 2011. There's a historic day. Anyone new to silver, go check that one out. We'll be talking about that plenty, amongst other things, but I couldn't remember silver being up $3 in a day. Now, this includes, I was trading through this in 2011 on the move to $50, and I would have guessed there were some $2 moves. Certainly, we've all seen $1 moves in the past year in silver. And I sent a message on Twitter. And fortunately, the great James Anderson of SD Bullion picked that one up. I was saying, has there ever been a $3 day? And he wrote back, close to close, even in 1980. I thought it might have been possible in 1980 because that spike happened very quickly. But James says that we have not had a $3 close to close day. So perhaps we'll have the first one today. I'm darn curious to see what happens in the open here in the US. This is going to be a shorter video because I'm going to get back to my trading station shortly, but I just kept thinking about it over the weekend, and a lot of these thoughts that kept building and evolving as we went along. Yet knowing the Western mentality, how there's a lot of buying power that chases momentum, goes after things go up, sells after things have gone down. For people who've been a part of this channel over the last couple of years, we've talked plenty. We've had the guests talk plenty about the way silver works and how I don't think the fundamentals weren't there over the last year. There's been exponentially more money printed the last decade while silver was getting pounded from $50 down to 11 or 12. There's been more money printing than ever. There's been more inflows than ever. The fundamentals have been more glaring than ever, but a lot of the interest was killed, which left a situation where, again, you saw gold come back into the media last summer when it crossed 2,000. And then people stopped caring about it for a while, which, again, this is my quest to be a great trader. And, I realize there's no need to feel this or that about it. It is what it is. Adjust and make your factored in, plan accordingly, which is what we do here. And anyway, now we can see the futures contract just ticked over $3 just for everybody watching this video. And I guess to finish what I was saying there, Americans in the West, anyone who's using US, Canada, that doesn't have First Majestic shares or is just hearing about it, I always wondered if there would be, once it finally gets in the news, that's when the whole world descends in. Yes, silver fans have known about what's going on. We've known about the First Majestic short position, the vulnerability. And to anybody who's watching this morning, as we talked about on the channel here, there's a short situation in silver. And then it appeared on First Majestic, which is heavily leveraged to the silver price. On top of that, because last year when silver went from $18 to $27, there was times when First Majestic was lower at $27 silver than $18 silver. And there were a lot of people who weren't happy because their mining stocks didn't go up during that rally last year. But this was the payoff, where now we look over First Majestic up 578, 32% in pre-market trading, which is just truly stunning. And here's the thing. If the Western world is waiting for the next 3 minutes to start getting First Majestic silver now, and they pile in, is it at least, are the conditions at least in place to see a further escalation of this? Yes, that's, to be clear, different than saying that is what will happen, but I'm going to be darn excited to watch. And, I would say, keep in mind, we saw Tesla go up 19-fold since the Fed started swap lines a year and a half ago. Bitcoin up 10 to 13x in the last year, depending on how you measure. GameStop went up, I think it was 25x at one point in a couple of weeks. And silver is not only trading a little more than half of its 2011 high this morning, it's still like just slightly more than half of its 1980 high before we had 28 trillion in debt, before the Fed was running a hyperinflation campaign, before things like quantitative easing existed, back in a time when if you had suggested negative interest rates, people would have looked at you like you were insane, perhaps rightfully so. And maybe this is the biggest sign. On Friday, we had Wall Street Journal covering the short squeeze in the silver market. And now on CNBC, on the front, silver jumps 11%, the most in 11 years. And here's the question I will leave you with as I get ready to sign off for now. If they turn their attention to silver on Thursday, you saw a rally in First Majestic, you saw a rally in silver. Then on Friday, you saw a continuation of that. Made out on Friday, 34 million shares were added to the SLV trust, which is a stunning number. That's like a quarter of, you could even say that based on that there was a deficit, according to Silver Institute numbers last year, that was the entire supply, and they took it in one day. Dealers got kind of blown out over the weekend. And based on what you've seen and the way things trade on momentum in the West, I don't know. All these people are watching. Wouldn't there be some people who are encouraged and going to provide some buying power today? So we will see. Hit that subscribe button. Hit the notification bell. We'll be covering you all week here. We also recorded an option trading call last night after the markets open late Sunday. Actually, some intriguing forecasts. And might enjoy seeing, especially how those play out already and throughout the week. So there's the opening bell. I hope everyone is just having a wonderful morning out there. If you're a Silver fan, you got to be smiling. Silver Bill Murphy, that is for you. We know you're smiling. It was great to see him yesterday. With that said, thank you all for being here. Hit that subscribe button, the notification bell, and I will see you shortly. Maybe silver will be up $3 or $4 in the morning. I don't have the first clue, although it seems nice that it's rallying there. I don't know. I think this morning I said if silver is up $3, wouldn't you think First Majestic would be up 5 or 6? Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on this rather historic Silver Squeeze weekend. What an honor and a blessing it's been to spend time with all of you this weekend and really just cover and follow these incredible things that are going on. And we did one last final call. This was a private Zoom call, but I think you'd enjoy it. And especially for some of the option traders out there, after the market opened Sunday night, we started this at 9 p.m. Eastern. And some fun stuff in there, especially to see how it plays out on Monday morning. So anyway, I'm going to play that for you here. Quick disclaimer, this is option trading on silver. This is definitely not legal financial advice. This is research, educational, considered entertainment. Definitely not appropriate for most investors. Very far different from owning physical silver or even mining shares. So I just want to make sure that's clear going in, but I think you'll learn a lot and it's a great way to get started, but just want to issue that disclaimer. Now with that out of the way, here we go. So we are back in Silverland. We got the Keynesian out of the party. Rob, can you unmute yourself? And I can actually, Rob, can you unmute everybody for a second? And let's all give Rob a hand for, in addition to all the things he's done. Rob, unmute them all so you can hear the applause. That's please unmute everybody for a moment. Wait. Start the applause now. Let's start joining in, and we'll get standing ovation for Rob Keys, who not only has boosted our portfolios, told us about great mining stocks, and saved things. Yeah. All right, fellas.
Thanks for kicking that guy out.
Thank you.
Goodness.
Rob,
Rob's going to the moon.
thank you, Rob.
Thank you, Rob.
Our new moderator
Yeah.
for the
All right, now everybody mute.
future option calls, and I guess that's part of the reason, where we're doing something that will be private so that we'll get all these kinks worked out. Oh, there's Matt. Matt, I didn't see you with your background. Hi, Matt. Can we unmute Matt Carr? Matt, how are you today?
I'm doing well. How are you doing?
I'm doing fantastic. I didn't even see in there. It looked like it was like some European bank you're like presenting. But great to see you. I know a lot of people met Matt Carr on last night's roundtable call. Matt, did you catch today afternoon roundtable?
No, I haven't.
Okay.
I didn't hear it.
It was interesting. Perhaps we'll dig into that in a little bit. I do not have a script for tonight. I'm going to go over a few things and then can take some questions. But anyway, now that we got things squared away, and Rob, where is? I do not see him on my screen. Wonder where he went.
I'm here.
Okay, there you are, Rob. So, Rob, thanks for getting that straightened out. And now let us take an undistracted look at tonight's silver price. And share a screen. Can you give me screen sharing, please, Rob? So, I mean, it's interesting. You know, I find I take a step back as often as possible, notice my own emotions, and certainly as like throughout the weekend, very amped up, and then the thing opens and know what the expectation is, but still in one level or another. We'll have a screen share in a second. Oh, there we go. Or no, I'm bigger now. But let's see.
Albert, it'll be an arrow above screen sharing. You'll see a small arrow, and then it'll allow participants to share screen.
I don't have that option.
You should have it above share screen. The green button. There's a small arrow on the top right corner.
Yeah, I know. It's not there though. I have one participant can share or multiple participants.
Yeah, so just do multiple participants. Then Chris should be able to share his screen.
All right.
All right. Is everybody in gallery view again?
Either way. Okay. Yeah, do the gallery view so we can see everyone. It's not to have my close up, but I'll do it radio style for now. And it looks like silver is up a little bit since we last did a screen share. I'm seeing $1.09 on Kitco and 28.74, which would be up $1.82, now $1.83 on the futures. So, Rob, you had an interesting thought last night. I guess it's like I've heard a few people feel the same thing, where not expecting necessarily like we're going to hit $50 this week, but that something is clearly changed. But I mean, I think this is like clearly evidence that an impact has been made. I mean, they blew the dealers out, at least until they, you know, out of what they had hedged. And the 34 million ounces to SLV was rather stunning. So, Rob, do you have any thoughts on that?
Just the 34 million ounces, or what specifically?
I guess just that clearly something has changed, and maybe you know, it's normal to expect things to go in stages, but
yeah. Oh, I think people are looking at SLV as a proxy for silver, so that's what everybody has access to more maybe so than physical. I think physical started to pop this weekend, but obviously SLV the last couple of days of the week. And they slammed it down on the futures market. They put, I think, 1 billion ounces a day, or 1 billion ounces in trades a day, Thursday and Friday, to keep the price down, even though SLV was exploding. And that's why silver price didn't gap up until this evening. So we'll see what they do tomorrow morning if they come back and slam it with more short paper on the COMEX.
Yeah, well, you know, I keep thinking about it. I don't know, I've been thinking about it for the last decade, but it's like you would have to expect that. So, I mean, all right, it shot up here and then got hammered back down. So I guess that's where, to me, especially as I get a little older and think about things differently. I remember when I was back on the trading floor, and if it went my way, I'd be happy. If it didn't, you know, but I mean, I find really the key is, all right, however I feel about that. I mean, really, if my feelings about it are relevant at all, you know, I think just to the degree like, all right, it's still $1 higher than it was an hour ago. And in some ways, while it's nice to see things reflected in the price, like if silver was down $1 right now, I don't think that would change the ultimate outcome. You could say, let's say you knew the day that the COMEX was going to fail and silver was going to soar. I don't know, maybe the day before that, silver would go down $3. To me, the actual COMEX pricing it tells you how maybe some gauge of what can be done with paper in the short term, yet I think the long-term outcome has always been clear. I think that long-term outcome, the timeline got shortened significantly with the events of the last week. How significantly, I guess we'll find out. But Matt, any thoughts on that?
Yeah. I had to unmute there. Well, I think, leading into the question that was asked earlier with regard to the First Majestic trade, the general answer to all things silver in the last 2 weeks is in the option tables, the premiums have exploded. So just being long premium either direction, you were able to make money. And, we're looking at a great opening here tonight, and tomorrow morning, and some of the names, we're probably going to see another blowout of premiums across the option table. So that's something definitely to keep an eye on.
Yeah, and Matt, as you got a phone call from a feisty friend named Chris like a couple hours ago saying, when do we get a quote on First Majestic? I guess there's no futures. I know the S&P futures are open now, but there's no pre-market trading. Wait a second, is that? I don't know. I don't think there's any feed yet, but I'm curious what happens. I mean, if silver is up $1, somewhere between $1 and $1.85, and I would say keep in mind by the time you wake up, I mean, what we're seeing now, and I guess I know I said we're doing an option call, and maybe this is an important part of options where, I mean, yes, there's the technical parts of it and the math and the vols and all that, but perhaps the mindset is bigger because, I don't know, I mean, maybe it makes me happy and there's a sign that but I mean, if it, we've seen that we can see it lower. So to be surprised if you wake up and it's down $1, I think it's almost to be expected, yet I don't know. I just feel like what happened this weekend, it's going to be hard for people to ignore that. And you have a lot of pressure on the market. And then on top of that, when First Majestic was one of the ones that was already targeted as a short squeeze candidate. So, I mean, if First Majestic went up the other day, I mean, silver was up Thursday and Friday, but I just wonder what a $1.85 move in silver, I mean, especially if that guy, they're done buying GameStop. Matt, what do you think with silver up? And Rob, if you want to chime in on this too, I know I asked you this morning, like, what did you think happens to First Majestic? Well, now we have a bigger data point. Now we see silver is up somewhere, let's call it between $1 and $2. Given that new piece of information that's been introduced, what do you think you would expect, let's say, if we wake up and when the bell's ringing in New York at 9:30, let's say silver is here, what might you expect in First Majestic? Rob, you want to take that first?
Yeah, this afternoon I said maybe up a couple bucks, but goodness gracious, we may have to change that. Silver, I mean, gapping up till 29, which was the last resistance point we had in 2020, where it got almost to 30 and it kind of stopped. And it's trying that again already. I think First Majestic may be up more than a couple bucks. I was being way too conservative there.
Yeah, I mean, it's like, I don't know, maybe silver be up $3 or $4 in the morning. I don't have the first clue, although it seems nice that it's rallying there. I don't know. I think this morning I said if silver is up $3, wouldn't you think First Majestic be up 5 or 6? And again, to be clear, like, these are complete guesses on one hand. So I'm not saying that this is what you should go base your trading strategy on. But essentially, this is like that, all this stuff in the option land. I don't know. I've had a couple people email me and say, "Hey, can you tell me a great option to buy?" I mean, I don't. It's not like a one-trick pony. I mean, it's more like an ongoing thing where perhaps more valuable. And sometimes I know this isn't the answer people want, but it's like, you know, can you teach me like which hand to play in poker? It's more of a thought process and understanding how to look at these things, which is what we will have been focusing on, even if it didn't seem like it. But the whole thing starts with, and if you remember the chart we had last time where you put your assumptions in, you know, you don't have to agree with my assumptions, but whatever you're looking at, I start with thinking, given what I know now, what is likely? And then think about what is unlikely but might also happen, and really trying, at the heart of it, you're trying to price a distribution. Options, you can hedge out directional risk. But when I say pricing and distribution, certainly silver being a good example of that. So, Matt, by all means, it's like, I know these are a little bit complex concepts, so can you stop me if I'm saying anything that isn't clear for people, perhaps?
No, I think that's pretty clear.
I mean, if you need me to re-explain, is like some of it's so silver, and Matt, as you know, really in any option trading, it's generally based off of that bell curve standard normal distribution, saying like, all right, if we're here, you know, there's some chance that most likely the price is going to vary around here, then there's less chance that it goes out to the tails. And then, you know, the far extremes, I would assert that my opinion, I think Wall Street always underprices them, especially they called us conspiracy theorists because we thought there was some reason that silver might go up a lot one day. And that's essentially what we've been talking about for the last couple of years on this channel. Now, here's the thing, is that just because people use a model that is based on a standard normal distribution does not mean that it is so. And especially if there was ever a non-standard, and let me slow that down a little bit. When I say non-standard distribution, meaning that it doesn't most of the time stay in the middle and sometimes go here and sometimes go there. Silver has a very unusual pattern where, okay, we know that at any random time it can drop $1. We've seen that, right, Matt?
Yeah.
So I guess what I was thinking about the other day is that if you just price your distribution better, don't worry about where it's going specifically, but if your bucket of probabilities is better, and so for example, if you are factoring in that at any random occasion, it can go down $1 for no news or no reason, the guy that's running the standard normal distribution, which is essentially your average Wall Streeter, is using a wrong distribution. So while it gets a little bit technical of how you extrapolate that out, it's similar to what we talked about last time, where if something's a 5% chance of happening and the market is pricing it in as a 1% chance, which you hear about this in the Fed fund futures a lot of the time, in the, you know, we won't dig into all the math of how that's done, but that's a printing press right there. If somebody's mispricing something by 4 percentage points, let alone 4 basis points, which would be 0.04%. Matt, am I on track here so far?
Yeah, it definitely is correct. I would kind of take a step back and just say options are a derivative, but they're essentially just a tool. And you can use them accordingly to whatever your goals are. You can structure directional exposure for less money out the door than buying the underlying shares. You can have that exposure without margin requirements, as if you were buying something on margin like shares. You could hedge existing risk of shares you already own. You could generate income on top of the assets you already own. And I'm seeing some questions here in the queue about, well, premiums are high, volatility is high. Is that a good time to buy something? That's actually a really good question, right? I mean, usually you want to buy low, sell high. So think of it the other direction. If it is high, maybe you want to sell it to collect premium, or you want to create some directional exposure. You can have combinations, and it just depends on what your goals are. You can really set up different viewpoints quite easily with options.
Appreciate you mentioned that, Matt, especially the volatility. I know we've talked about this before. We also have new people in here. And this is really at the heart of it because, yes, there is the directional element to the options. You know, if you own a call, it's nice if the thing goes up. If you own a put, it's nice if it goes down. But you can easily hedge that directional risk out. And really, the way that I was trained to think about this is to think of the straddle. So let's say the stock price was 18 bucks. So at the money strike would be the 18. And if the stock were $18, means it would be 12 cents lower. So you'd see the calls a little bit lower. You'd see the puts a little bit higher. And Adam McBride, and I saw Adam hop in here, and Will McBride. Will is actually the maker of Market Chameleon. Rob, maybe could you take a look and see if you see Adam or Will McBride? They can hop on here and perhaps show some, just guide me along if I need a little assistance. But so anyway, if the stock was right at 18, there are a couple other factors, but to make it simple, you would see these be the call and the put would be equal. 18 is the strike, gives you the option. The call gives you the option to buy stock for $18. Put gives you the option to sell it at $18. So on expiration, if the stock is $20 and you have the right or the option to buy it for 18, and you could sell it simultaneously on the market at $20, it'd be worth $2. Whereas your put, which gives you the right to sell stock at $18, the stock went up to $20, you would not exercise that put. Your put would be out of the money. And perhaps can you type in the chat field if that makes sense? I am assuming that it might be good to explain that multiple times, but everyone, let's see, my Zoom is a little slow here, but yes, type in the chat if that made sense, if you would like to hear that again. Okay, I'm hearing that did make sense. Okay, I have no idea what's going on. Where is the silver? Josh. I'm gonna send Nibbles over there after you, goodness. Josh Lown. Josh Lown, crypto billionaire and silver mogul, who I'm very darn proud of. One of my favorite, I don't know if I can call him a student. I mean, he's just a genius in his own right. But Josh, it is great to see you here. So again, back to the options here. In the middle is your strike. And if you buy the call, and I'm going to repeat the same exact thing I just said before. If you already got the first time, you could hear it again. It'll be good for you. But for anyone who didn't quite get it, it's okay. And maybe I'll leave that chat thing up because that way I can take questions. I'll just move it over there. And by the way, there is no question that is as stupid as some would assert. These are complex topics. It took me like years of getting yelled at by angry bipolar traders on the New York Stock Exchange. And, and so that's why we're here to learn. So again, to repeat, there's your strike. When you're buying we'll just imagine if we're buying it for now, a call, you're paying this premium. It's going to cost you $1.78 here to purchase the right before this expires in 5 business days. So if you paid $1.70 for this And the price of First Majestic at the expiration was $19.70. All right. So if it's $90.70, you have the right to purchase the stock for $18, sell it simultaneously on the open market for $19.75, which it would be in the money, or $19.70 rather, and you would be breaking even because you paid $18 for the stock plus this premium you paid.
Yeah, not bad.
So what's it? So $19.70 would be your break even. And if you can type in the chat window, if that made sense, hopefully. And essentially, so if it goes higher than that, let's say First Majestic was $21 by the expiration, you have the right to purchase the stock for $18. You can sell it simultaneously at $21, which is the price on the open market. And you paid $170. What's referred to as the intrinsic value or parity would be $3. So you paid $170 and you won $1.30. So you got less than a 100% return, but still pretty good. And basically the real joy of options, in my opinion, is that you have the unlimited upside. So, and especially why it was so intriguing that life sent me in that direction to have that background with silver is that, let's say for a second we had in First Majestic silver, we had something like what we saw on GameStop. GameStop went from, I think it was $20 up to 500, and I think it's 300. Let's call it 300. So $20 to 300. Matt, is that a 15 bagger? 20 to 300? I think so. Does that sound right?
Yeah.
Okay. Matt actually is a former rocket space, like nuclear engineer genius. So. Well, I won't embarrass you on the call with how smart you are. I'll just be grateful that you check my math for me while I'm doing this. So anyway, and we have a physicist in the chat too. So basically, right now, here at the 18 strike, neither of these are in the money. You buy the put, again, we're assuming the stock's right at $18. That would be, it's at the money, was how we would refer to it. So how do you know? Let's say this was $1.65, this was $1.65. That would mean the straddle, which is when you own a call and a put on the same line, would be $3.30, which I believe is $1.65 times 2. But here's the thing. So you could buy that straddle, which means, and if you paid $3.30, you didn't have to care which direction it goes. If it goes over $21.30, which would be $18 plus your premium paid, you'd start winning if it goes past $21.30. Or if it started going down, 18 minus 330, let's call that $14.70. If it goes down below that, then your straddle is in the money. But here's the glorious part, at least pertaining to our particular silver situation, is that while on that trade, the most you're going to pay is $3.30. It's like, think of it like an insurance policy. You pay the premium. If nothing happens, it expires worthless. But if you have, for example, in fact, this would be a hoot. Let's pull up GameStop, and if any GameStop fans still in here watching, you could just ask. I would have talked about the option bar. You're gonna have to hijack everything, but that's okay. So here now, in fact, Rob, did you find Adam or Will?
I did not.
Okay.
There's no McBrides.
Well, I'll tell you what, I'll bet there's some way to do this that you could actually, what would be interesting, in options, it's great. Just remember, like, find the equivalent comparison. It's a trick. And Rob, can you remind? I will write that down and remember. And or maybe I'll just explain it now, since I don't see my pen here. But let's get the chart. We'll come back to that. So, and I'm going to move this up there. So let's say you had purchased, like, if you go back here when things swimming along, looks like, I guess actually somewhat volatile. I mean, here it's 13, 12, 11. This is back last November, 16, 20. So, I mean, it's not a utility stock. I mean, it moves a bit. But the thing is that the price of your options was a lot cheaper here. Once this happens, the price of any option just skyrockets. So, for example, that straddle that we were looking at in First Majestic when it was 330, the vols are jacked now because the thing was going wild on Thursday or Friday. If you, in fact, actually, it'd be great if you go back. I'll tell you what, would be fantastic. Highly recommended. Go back to watch the call we did 2 weeks ago. It's on library in our site there. And you can look at the prices, then come back and compare them to what you see here, and you'll see how much more expensive. I think we were looking at. Actually, I can tell you exactly. So, good news. Let's see. So I think it was right. This today is the 31st. So Friday was the 29th. So, okay. So we did our last call. Silver was, or at First Majestic here was, let's call it 1181. And I believe we were looking at the 13 line, and it was either 11 cents or 13 cents. So when I said before, the secret to options is to think about comparisons. So we were looking at it, if you recall, it was a 1 week option. And I believe it was the 13 strike. So how I can use that to compare to now is like, all right, $1.20 out of the money. We're going to use 1181 in this example. The day here, you can always adjust this, but for the example, we'll use 1181. So the 13 strike, which means if you buy the 13 strike call, you have the option to pay $13. Well, expiration rolls along and the stock's 1181. If you really want to buy the stock, you'll just pay 1181. You're not going to exercise that option. It would be considered out of the money. And I believe what happened, though, is that, because I remember it closed that week right at 14, which would have been, yes, the 22nd. Yes, which would have been last Friday. So that 13 strike, I don't remember if it was offered at 13 cents in that example or 11. I think it might have been 13 the night we were looking at it. So that you paid 13 cents for the 13 strike. I think it was 11, but we'll say 13 cents for the 13 strike. And because the stock expired, the stock at expiration was $14. And Yara, in this example, actually put this one on, and she paid 11 cents, I think. Yeah, I think it was offered at 13 cents. And by Monday, it had come in a bit because the vol, there's a time decay as well. So she paid, let's say, 11 cents for an option that ended up being worth $1, because by expiration, she was able to exercise her option to pay 13 for the stock. She purchased an option for 13 cents. It gave her the right to exercise and pay $13 for the stock at expiration, which then she was able to sell at 14. So she paid 11 cents for something that ended up being worth $1. So basically 9-to-1 return, I believe, if I'm bring my multiple math correctly. And everybody, if you can type in there, if that makes sense. And perhaps maybe this might be a good time to take some questions. I think there's that hand raising thing. So even if you just want me to explain everything I just said again, that's completely fine. Rob, maybe you could moderate that, but raise your hand. Does everybody see the hand raising button somewhere? Rob, could you explain to people where they could find that if they would like to ask a question, and you can call on them?
It's in the reactions. If you click reactions at the bottom window and click on the raise hand option.
All right.
And we've got one from Tarleton Long, who's raising his hand. Tarleton, you want to jump on?
First of all, I'm going to answer Franco's iron condor question. I remember it from like 15 years ago. It was one of those things that traded like once or twice a year. And generally, from our perspective, like in Susquehanna, we were market makers. So we're kind of like always on guard. Basically, the job was like, is this the order that's just retail trading and is, you know, we kind of hedge out? Or is this the guy that's like a hedge fund that spent the last year analyzing this situation and he knows what the biotech's going to do before us? So the iron condor was usually one of those two. It was either someone who had no idea what they were doing or they were going to pick me off pretty bad. So I actually don't even remember. Iron condor, sell put spread, sell call spread, out of the money each for credit. That sounds about right. It's been a while. Those very rarely traded, which is not to say that they don't trade, but I would have to look up the iron condor. That one's built.
Rob, I'm ready when you are.
So, Rob, did you have the?
Rob, can you hear me?
Yeah, Tarleton, is that you?
Yeah, it is. Here's my question. All the excitement is, of course, pro forma for a theoretical short squeeze. And I'd love some analysis of the futures book on the COMEX. What contracts, how many contracts, what type parties, and how are we going to know the squeeze is on? How is it going to show up in the contracts next week?
I'll say what happened on Thursday, Friday. We don't get like transactional days. I can't tell you exactly who, but I can say, and we won't know the COT data right away. The COT data is about a week old, so I won't be able to tell you if it's the bullion banks, which it probably is with the short volume they typically are. But there was about 1 billion ounces of silver contract traded Thursday, Friday, and as I watched the trades go down, they were net shorts. If you look at the settlement prices, they were net short of where the silver price was. So there's more pressure to the downside. I'm looking at Friday's number. There was 188,000 contracts on Friday at 26.91, and on Thursday 191,000 at 25.92 for March, which is the dominant month now. It's the one that has the volume for the open interest for silver. Let's see what the open interest is in March. CME Group is slow loading, but it's about 135,000 contracts. So just an absolute ton of shorting on the COMEX Thursday and Friday. And we'll see in a week who's doing it, but it's 99% of the time it's the bullion banks.
And that's in the face of the chat rooms speculating on the squeeze.
Yeah,
Seems
because
to be in response to
it's in response to it because you saw the SLV get that bid and it wasn't just, I mean, it was several days that people were putting money into SLV. And I think that was a result of a lot of the chatter, right? So you had, the Reddit channel, you had probably a lot of other things going on where people are talking about it. You saw this massive influx into SLV, which is the ETF that a lot of people who have stock accounts are going to put their money into. Maybe before they buy physical, first they're going to go try to buy SLV. So you're going to see a lot of Robinhooders do it. You're going to see other people do it who have brokerage accounts. And so that happened. And as that was happening, they were slamming down the futures market because really the futures market is what determines the price.
Yes. Well, those 190,000 contracts represent a hell of a lot of capital. How are the retail and market going to overwhelm the bullion banks?
Sorry, I was getting a very loud motorbike outside my window.
I'd like to take a crack at that one if I may.
Go ahead, Chris.
Yeah, well, I mean, they trade a billion ounces a day, basically. I guess, Tarleton, what I find interesting about what we saw this weekend, I don't know that it necessarily has to be the retail guys. Now, I don't know. I know some people have done the math. You could look at how many people are in there. If each person buys 3 or 4 ounces of silver, you know, that could conceivably be enough. I don't know how realistic it is to like quickly assemble a plan to get everybody. But I think what's more likely to happen, in fact, I'm going to make a note to call. There's a couple of guys from my old trading shop that I talked to. I texted one of them this weekend. I used to talk to him about silver before I left. These guys were good gamblers. They started the shop because they used to go to the racetrack and win. They understood probability better. And I'm curious what they are doing, what other shops are looking at, because to me, it was always based on keeping a secret. So once the cat's out of the bag and like shops with significant capital access and sophisticated ability to put something on. So I don't know. I mean, again, you never know who is in that group. Maybe there's 5 billionaires that say, all right, I'm going to buy a big chunk of silver. That could conceivably be enough. As we mentioned in that roundtable today, you know, that's still the big mystery. Like how many, it could be that the next ounce, like somebody could try and take delivery of one contract and they don't have it and that would break it. Or maybe it needs some massive amount that seems bigger than what I could fit in my truck behind me. But I don't know that there's going to be data in the COMEX that's going to indicate it. I mean, it's a legitimate question. And in the way that we've been grown up, and I think most people think logically of how to calculate something, and it's like finance is supposed to be about the numbers, and it's like, you know, they made a profit or they didn't make a profit yet. I don't know that you can quantify, like, how do you, all right, they bought 34 million shares of SLV on Friday. They buy 70 million on Monday, 200 million, they sell 34 million. Based on what I saw, I mean, we have, you know, usually we've been changing the schedule a little bit. Normally we do the one show a night. We get 5,000 to 15,000 people watching. Now there goes silver down a little tick there. So we'll go to the one that has a higher price and cheer everybody up. So normally we get 5,000 to 15,000. Now today, the ones we did this afternoon, I think it was like 40,000 people watching in the first hour or so. So there's clearly a lot of attention there. I don't know if like 5 people like Eric Sprott said, okay, well, for example, let's say Steve Cohen, or I'm a Red Sox fan, so I've wondered before John Henry. I mean, I think they're more of a technical fund, but some of these, you know, if you have like a couple people that are finance guys that have the capital, I wonder if maybe the retail crowd, or I don't know, and again, I don't know, I'm just guessing, but maybe let me put it like this. If the retail crowd just made it such a spectacle that you get, I think I pulled it down, but the Wall Street Journal even covered, Wall Street Journal had an article about investors targeting a short squeeze. So that's some powerful advertising that, I don't know, I'm doing my show for years. Bill Murphy's been, you know, pounding away for decades. Rob, other people are doing this stuff. Yet, I mean, like when you put it on the Wall Street Journal and all the different places people are seeing it, for whatever reason, I have this, I don't have a name for it, but it's like there was something about like the OJ trial, for example. I mean, yeah, it was certainly, you know, he's a well-known guy, but like there's other scandalous stuff that's involved celebrities. Yet for anyone who was around, you remember like the media attention was insane. It got to that, and my guess is usually when we see stuff like that, there's a reason why, because it's like there's stuff wilder than OJ since then. But I remember being in, I think it was 10th or 11th grade trigonometry. Only time ever. They stopped the class to read the verdict. So whatever the reason is, like there's that degree to which now, and especially with, I mean, I'm guessing that GameStop, I don't know anything about it. So maybe it's the greatest stock ever. I'm guessing it's probably not worth $500 a share on a fundamental basis when it was trading at 20. But I mean, what I think is a little different here is that you could make the case that based on just simple inflation adjusting from the 80s, let alone however you would truly factor in the money supply. So sorry for a long answer, but hopefully that clear. Like I think what you're asking is a great question, and there's that part of me that on the other side of all of this hopes that we can go back. I think we all grew up thinking like, hey, this is fun. You know, you can do your homework, you research something, and if you see where some, you know, you buy and sell. And that was part of why I left Wall Street, because unfortunately that's not how it works right now. And I may like that or I may not like that. But to me, especially at this particular time, I think, and especially, you know, you could say, well, you know, a lot of people think a lot of things. Well, the financial markets is one of the places where what people think can be directly impacted. And I would say, again, do I think silver is going to go to $500 or $1,000 this week? I don't think so yet. That would, if silver went to $500, since it started at 25, while GameStop started at 20, and I would suggest that the fundamentals for silver actually, you could make a case that would support that. And in this type of environment where everything is so levered, what was it? I've heard slides that 40% of the dollars that are out there were printed last year, and Bitcoin goes up 10x. Tesla, I don't think, maybe they finally made a profit, but goes up 19x. So, Tarleton, anyway, any thoughts? Did that help put it in? I know it was not maybe the answer you were thinking.
Yeah, I share your sentiments, and no telling what long it would do to explode the price of silver. I just, it's going to be interesting to see how serious the wars get, and do the bullion banks go nuts to, again, not let it happen.
I would fully expect that. As I mentioned this afternoon, imagine it's like one of those movies where the devil's fighting for his life.
Are you guys familiar of the theory of why Wall Street Bets thinks that First Majestic was targeted?
Can you say that again, please?
Are you familiar with why Wall Street Bets? I saw a post that was a theory of why First Majestic was targeted for a short silver squeeze. Do you know why? I don't know if it's true, but they're saying that it's because the CEO of First Majestic was the only CEO to withhold silver when they smashed the price down to $14.
Yes, he was.
And the bullion banks are furious about that.
Well, I mean, I guess I kind of agree, and kind of in the sense that, I mean, I'm guessing that I've wondered before. I mean, you would think based on the stuff that Keith says. I mean, if we're talking about banks that sit there rigging gold and silver nonstop, it's not like they don't trade stocks too. I mean, these are the biggest banks. I don't know. This is not based on any inside information, but just thinking about it logically, you could pick any market out of a hat. And if you ask me, like, if I have to make an even money bet, is it more likely or not that it's somehow manipulated in some way? I mean, think about it. You have, this one will be, is one of my favorites. We have the Fed that manipulates the bond market, but because they conned everybody into like playing their roles and they call it policy, that it's normal. But wait a second. Like the market likes, is buyers and sellers are willing to extend credit and borrow at 6%. Bernanke shows up and says that's bond market manipulation. And we've seen JP Morgan get caught manipulating a ton of markets. So, I mean, to me, what we've been pricing in for the last couple of years is like, it's not, there's part of me that wishes it was quantitative, but it's qualitative stuff. Like when what they did to the Hunt brothers. I mean, you don't have to go back 40, 50 years. What they did 2 days ago. And Matt, can you comment?
Yeah.
I heard, is it true that there are some people that were not even on margin? They were at fully cash paid for position in Robinhood on some of the stocks like GameSpot or AMC, and the brokerage just sold them out. Is that, can you confirm that? Is that true?
Well, there were liquidations. I'm not sure if they were situations where people did not have margin. With respect to that question around First Majestic, I think one of the common things that sticks out here is that it was a stock that had nearly 30% of its float sold short. So there was something with GameStop that was much more acute. And the people on Reddit, or at least people that were discussing this a few weeks ago, actually understood the concept of targeting the call options. The entire thing with GameStop started with the call options. They were bidding up the calls, and they understood the feedback loop to where the market makers would have to go buy the underlying shares as they sold call options to these individuals. So if you see something feeding through,
excuse me, if you're
First Majestic.
Besides from Matt, can you please mute your microphone? Getting some feedback from somebody. If you can unmute Matt, I think you're good to go. Thank you.
Yeah, so that I'm just saying the short interest on First Majestic is something that sticks out to me that people have owned in on.
Yeah, and I was giggling there. Rob, thank you. I feel like so VIP. I can just, it's like Tony Stark and Iron Man. The computer, mute that, and Rob takes care of it for me. Anyway, yeah, I think it makes sense that Keith would have been targeted. I can't imagine they like what he says.
He's also one of the only CEOs that's talking to all these CEOs at Silverfest and talking about, you know, $300 or $100 silver.
Yeah, and I mean, I think that factors in. I don't know that banks or that short position is specifically targeting him. If you told me that was the case, that could seem plausible. I don't know. And again, that's one of the things. In fact, if I may make a little sidebar here, Woodrow Wilson, we're talking about silver and options, and I'll give you a little piece of option knowledge here, my friend, because one of the things that people who do not trade options, and once you get the hang of this, you'll start seeing it all the time. People generally struggle with the tail risk because they think things that, you know, they're just like, oh, that'll never happen. Key example, when I started digging into silver and looking at the balance sheet following the collapse of the subprime bubble, and I asked the guy that was my boss at the trading shop, I'm like, hey, that situation here in the US doesn't look ideal. And he's like, oh, well, things like that don't happen in the US. I think we're finding out that they do. And I guess the concept I'm getting at is that there's, especially in trading, just because I don't know something, now maybe I can be sure that it's not there. You know, it's like, for example, if I'm making probability distribution for options, I mean, there's a lot that I don't know. So, I mean, I think of the right way to phrase this.
I think there's also a lot of people that just want to see the system burn down, and silver might be the way to do that.
That's true, but I mean, again, I'm trying to get at the point of not assuming what you don't know, just because. So that, and that's kind of what I was getting at with the political stuff 2 weeks ago, where I don't think that the QAnon is a straightforward source of information. I think it's more likely to be a psyop. I think there's parts of truth mixed in, as that's usually how a psyop is orchestrated. And we won't get into that tonight, but it's like there's certain things that I hear a lot of people say that sound rational. They sound incredibly confident about it. So my thought is that I can say, all right, I definitely know he's wrong. That's also what I heard people tell me about silver for years. So that trained me to think, why don't I hear what the person is saying? And then, when I have that more information, then you can rule. But people rule out things that are unlikely and call them impossible. And I would suggest, if anyone thinks that they don't agree with that, we wouldn't be here right now, because this is the epitome of it. And that's something. So we had questions saying, Silver Talk wanted some options, and whether that seems directly related to options or not. I would say, if that makes sense, if you get that, if you think about that, and I'm going to open the chat again, let me know if that made sense. I know it was a little awkward, my explanation trying to put that into words, but it's like, yeah, the technicals have their rightful place, but I remember Phil Hellmuth, the poker player, who actually is quite interesting, has changed a lot in his later years. Kind of nice to listen to now. And he talked about, would you rather be the 9 out of 10 poker player with poor money management, or 8 out of 10 on the skill level, but great money management? And the guy who's 8 out of 10 is going to live a much better life. And especially if you're trading options, Rob, I was telling him this morning, I remember my early days clerking, where I'd be sitting next to this guy, who was trading this stuff, and I'd be watching his P&L, and it was kind of like that chat window when we had a lot of people in there, and it's like 1 second it's up like 200,000, and and it's adjusting the marks constantly, be 200,000, 100,000, 300,000, 0, and I'm like, oh my God, how are these guys handling that volatility, that within seconds it's going up or down? That's part of it. If you're going to buy options in what you expect to be the most volatile market ever, and if you don't expect that, you shouldn't be buying or doing any options in silver. If you're not expecting at least the possibility of the banks dropping the wrath of God tomorrow, I'd be careful. Doesn't mean you shouldn't put on a trade, but these are the possibilities you want to think about. And when you think those through beforehand, then the rest all becomes easier. So perhaps I'll stop there. Matt or Rob, any thoughts on that? And then maybe we'll open up to some questions again.
Just to circle back to the other question, I think, about around futures, a couple of things I would keep an eye on are the margin requirements. When commodities really start to move, the exchanges can raise margin requirements. And what that actually means is you have to post more cash to the exchange. So you get de-levered, and different participants start to play in the pool when those things change. It can be dynamic, so you have to keep an eye on that. That changes all the time, especially in periods of distress or exuberant markets. The other thing I would keep an eye on is I would be watching what proportion of contracts are taking physical delivery. I know this is an options call, and now I'm speaking to futures. These are all derivatives. Essentially,
You're good,
what
you're good. Go for
people say, with metals, they like to have physical, but removing the physical from the system is something that is not just electronically created. So those are two things in that regard I would keep an eye on. I think that was Tarleton's question. And with regard to mining shares, given what we saw last week, given the discussion we had in options a couple of weeks ago, 2 weeks ago, the question was, how did that trade work out? Well, if it was a call spread on First Majestic and it matured, it expired last week, depending on where you bought and sold the calls, you made anywhere between 25 to 35 times your money. Now, that was a very short-dated situation. Oftentimes, people aren't looking to participate in things that mature or expire within a week or a month. So that was very particular. But given this unique situation with AMC, with all of this excitement, and a group of people seemingly targeting call options of companies that have been heavily shorted and might take a week or two to cover, what does that actually mean? That means the people that shorted the shares have to go buy them back in the open market. And if a large proportion of the float has been shorted, it can be difficult working with your prime broker to get the locate back. So it takes time, just given the day-to-day volume of how many shares trade. So if people are really aggressively targeting that gamma feedback loop where they're bidding the calls up and the market makers go in and buy the underlying shares, that has huge implications for the options, more so than the shares. You know, the GameStop underlying shares have exploded, but the call options are something that you rarely see in anyone's career. Things like implied volatility of 1,500%. These are just numbers that they're not common to come across in any sort of situation. People are not thinking about 1,500% implied vols. It blows up everybody's models. So this past week, we saw a lot of liquidation selling or deleveraging by funds because no one is taking into account these types of movements, especially funds that are managing derivative books.
Yeah, I would agree with that. You got to remember, or you don't have to, but I find it's helpful to remember. So the difference between being a research analyst and trading profitably. So it's one thing to figure out that everybody, if we're correct, that the rest of the world is missing the boat on silver. But to get paid off on your trade, if you buy it, it doesn't necessarily go up just because you bought it. You're waiting for the rest of the world to realize what you know, assuming that what you know is correct. So I would say that I do continue to think there's going to be some sort of break point where I mean, you know, if you reach the failure in the COMEX.
I think even if we don't have a failure in a COMEX, it'll be just the government admitting it's broke. I mean, you have so many different factors that could break this market. It's not just, you know, oh, well, people want delivery on the COMEX. If they pass a $7 trillion stimulus, what happens then?
I agree with that. And just on questions, if you could raise your hand first and then Rob can select you just that way. So just I can't always see who's asking. And but I guess that's what I'm getting at. Yes, there's a lot of factors that would indicate, and you could see things get out of control this week. I wouldn't be surprised in the least. But just, I think that's also because that's the balance in it where, I don't know, I mean, you could go bet all your money on call options expiring this week. And if it goes nuts this week, you're going to make a lot of money. But there's a chance that it goes on a different timeline. And you've been reminded of that over the past decade. So and I'm not saying to you specifically or anyone, but that's what I think about. So it's like that balance of where when you're poker, it's like, yeah, you want to be in hands, but the more you resist that urge when you're like, yeah, this really isn't an ideal spot. And one thing, I have two notes here, actually. We'll talk about more, Matt. I think tonight we could dig into in a little bit that thing I was saying, like if you just looked at buying randomly after you see the spike down 10 times, how that might break down. And I'm going to talk to Renra hopefully this week.
Yeah, I see there's like quite a few people with hands up.
Yes, so go ahead and pick a question for me.
Yeah.
Go with Dwight Emerson. Hey, Dwight.
There, can you hear me?
Yes, Dwight, go ahead, sir.
Hey, first to say thank you to Chris and Rob and Matt. I've been listening to you guys for a year now, and I bought silver back in the 80s through Merrill Lynch and ended up taking delivery on 1,000 ounces and came as a bar too, actually. Still have them. My question goes to Matt. I've been looking at MUX, and they've got a large short position on the float, like 16.5%. And I've got a position that, following you guys, I've got positions in several. I'm thinking about risk management, Matt, that you were talking about. I was thinking about writing a covered call for the 19th of February. And so I'd get some revenue, and I'd get, if it does close, I'd get double my investment for that portion. And I'm looking at what strategy, Matt, you might use to price what your ask would be. Would a 30% above on what it closed on Friday be reasonable?
Well, when you're looking to create yield in a situation like that, one of the first things I would bring up is the tax treatment of it. If you do get pulled out of it and it ends up trading above where you sold the call, or someone exercises the options on you, because all of these options are American.
Yeah, let me stop you on that. This is in a Roth IRA, so there are no tax implications.
Okay, so there's nothing taxed. Really, it just then comes down to your goals, what type of yield you're looking to generate, how far out, what's acceptable, and how much upside you want to capture. 30% up, 30% is a great rate of return. We're in a world where interest rates are zero. So I think right now people are excited in certain areas of the market, but you also have to weigh that against general prospects over the longer term. And
let me stop you. It would be 100%. What I'm asking is, what strategy would you use to what you'd go in as an ask price, given what the closed at on Friday? Would a 30% premium above Friday's ask price close, given that it's 12 times the normal volume for this stock? Would that be a reasonable thing?
It would be, but MUX, that's McEwen, right?
That's right.
So that has a single digit share price, if I'm recalling correctly. Is that maybe low digits, a buck or two a share?
121.
Yeah, it closed to 121.
Okay, so in situations where the share price is numerically low, you always have to just keep in mind that your options with regard to strike price are further apart. So you don't have as many prospective options to sell. But yeah, 30% is totally within the realm of reason as far as targeting and looking to collect.
On an open ask price, this is an active contract right now, and the bid was 10 and the ask was 15, and I thought about going in at 20. And as I say, it's been very active. I'm thinking if it does go up with the volume, does it go? If you got a high volume situation like 12 times normal average volume, would the expectation be, what would your percentage above the previous ask that you'd price it at?
Well, options can be spotty in volume, and especially in shares that don't have large tables, meaning a lot of strike prices. So something that's trading around $1 or $2, it isn't going to have as many strikes that you can utilize. So to foretell the volumes, the liquidity that you're going to see is somewhat difficult. Yeah, Chris?
Matt, just 1 second to point out what Matt was saying here. So here the stock price is $1.21. Now, if we're looking at February 19th, that's 14 business days, so 3 trading weeks. You have the dollar, which is the dollar strike, which is around the money. So you have the 2 strike. Now, if you go out a little farther, I don't know if you have an idea of what, how far out you want to go, but they're kind of far out of the money. And just what Matt was pointing out, as opposed to First Majestic, you have like a full, it's $18 stock now, and there's more these candidates to choose from, at least if you can see that on the board now. Does that make sense, Dwight?
It does. Again, it is the $2 strike price I was looking at. And
which month?
February 19th.
Okay. So why tell me the covered call. I have a little bit of a non-standard view on these, but I'd like to hear why particular, what you like about that trade, and then we can dig into it.
I've got a fairly, relative to everything else, I've got a substantial position here, and I was looking at reducing the exposure, reducing the risk, trying to get some revenue out of it. And if it gets called at 2, I'm fine with that. I've still got a good solid core position with this company.
What do you think is going, why do you own the stock?
Well, listening to you, I went through an analysis and also talking with Rick Rule and listening to him. I put together a portfolio that included solid value, and this ended up on my speculative end. As I say, I've owned silver for 30, 40 years.
If there's a short squeeze in silver, what do you think happens to the price of McEwen Mining?
I think it'll go up. I think rising tide will lift all boats. If it goes to $3 or $4, that'd be great because my core position would still be there.
But you would miss that upside if that happens while you are writing your covered call.
I would miss the upside on a portion of my holding. That's right.
Okay. That's the thing, which again is fine as long as people realize that. I find often I don't think people get that what they're trading off. And I'll to explain that for folks. So let's say you own the stock and then you buy the 2-strike call. So you would be selling the 2-strike call in this example. So if the thing goes to $3, after it goes up, you have to, since you're selling that, it's the opposite of what we said before. So you're the one who has to deliver the stock for the other guy to buy. So if McEwen Mining goes up to $4, that 2-strike, that guy's going to exercise it.
That's exactly right. It happened to me early on, about 20 years ago. I felt terrible when that stock got taken from me. I said I'll never sell a covered call again. With practice, you get a little more experience. So I'm comfortable with that because I hope it does go to 4. But I've got to also control risk.
And I think that's great to be controlling the risk as long as let me pull the chat back up here. Let me know, folks, if other people, where the heck did the thing go? If that makes sense. And if you understand what we talked about there, because that is an important concept. So, I mean, as long as people like that, and as I think you guys probably heard, we are setting up a private program for options and going into stuff where, I mean, everyone has their own assumptions. And what I would like to do is help people. So if you think this, here's some options you can look at. I mean, if the underlying view is wrong, then I'll tell you, well, if it's wrong, that's going to happen. If it's right, that's going to happen. And just make sure that people understand the risk, because I wonder sometimes, and I'm glad to hear, Dwight, that you understand what you're getting at there. And do people see, can you type in the chat room if that makes sense, how if you sell the call, and Dwight, the reason that I generally don't do that was 2 reasons. One is a little more complicated, we can leave aside from now. But let's say that I think First Majestic, there's going to be the squeeze. Like, let's say First Majestic goes to $30 this week. If I sold the 20 call, but I own the stock, I'd win up to 20, but then I don't get that 20 to 30. So again, which is fine. And everybody, the best thing is you don't have to invest how I do or how Dwight does. Find what's right for your personality, but just understand that there's different combinations of different trades. That's what's so great about options. You can find really specific ways of measuring. That's why they're derivatives. Stock, you buy it, goes up, great. You sell it, goes down. But the options, well, do I buy the one, or actually in this example with Dwight, which strike do you sell? Do I sell the 1 strike? Do I sell the 2 strike? You're getting to measure extent, degree, which is worth thinking about, because that's something that I find people often overlook. In fact, if you find that you notice things that other people in the markets often overlook, then option trading is great for you. If then you learn how to take that and you want to figure out, all right, because that can be a great starting point. You know, everyone thinks the Fed's going to do this, and I'm like, that doesn't make any bit of sense. And options can allow you to be very specific and precise in how you express something, with an example being, you know, we hear the Fed prints a lot of money. Okay, well, that's true, but do they print 1 trillion? Do they print 10 trillion? There's a difference there. So that's why I love pulling up this chart. If anyone knows where I can get a chart, I haven't been able to find one that goes back to all the way back to 1913. This would look even more silly if you took the, let's see what we can get all here. How come the Fed's own junk website can't even show you past when they started hyperinflating the currency? July 30th of 2007. I mean, right when subprime was raging. I mean, with all, can't even give you data. But again, I think, you know, if you drew this chart back all the way there, in fact, hold on a second. I will get a slightly better chart than that one to demonstrate this example. Monetary base, let's pull that up. St. Louis Fed, there you go. Again, I'd take any
Chris, while you're doing that, Chris, could you contrast, let's say, a Majestic to a McEwen, one being close to $1 stock, the other, and in the balance sheets of one much stronger than the other, given the environment in here? Are you more likely to try to use options on the more speculative or the more solid companies?
Well, the answer depends, is of course. I would have to remember the math behind this, but it's like buying 10 contracts on a $1 stock is not the equivalent risk of buying 10 contracts on a $10 stock. Matt, do you remember the math behind that? I believe it's like there's some exponent in there somewhere, like because it's like when you go to like one contract in Tesla, which is a $900 stock, carries a greater degree of risk than probably like 100 lot in the $1 stock. Would have to revisit the math. It's been about 15 years on that one, but do you get the basic point there, Dwight?
I do. I'm just saying,
because think about it like this: like if you have a $1 stock moves 50%,
yeah,
50 cents, $10 stock, that's $5. So,
yep.
And you're using a derivative, so that compounds in there somewhere that I could review some other time.
Let me ask it another way. Do you think as these new entrants come in, they'll be more attracted to the more speculative type of stocks or the more stronger balance sheet type of stocks?
I don't think the money is going to come in there is going to care or have the first clue. We'll probably go to First Majestic because that's the one that they know about.
Mm-hmm.
In fact, it really hit me as a year or so ago at this breakfast for EMX, royalty streamer. Everyone I talk to says they're better than sliced bread. So maybe Rob can comment on it if necessary. But we were at this breakfast and it was like this was before I'd figured out how to monetize the show. I was a little panicked. I'm like, I'm gonna have to get a job soon if I don't figure this out. So, but it hit me that day where I heard enough people talk about it that I'm guessing probably the numbers, the company is going to make a lot of money. Yet, when you think about all these mining companies, like can't get EMX research from Goldman Sachs. I mean, I wouldn't trust it even if you could, but you know, you can get articles about First Majestic, but like some of these small miners, most people don't even know about them. That's the thing that's great. And one of the things that I try to bring to the show, any of the companies I bring on are vetted in some degree. I make sure it's not like a Ponzi scheme. I'm still learning. I don't have Rob's level of expertise in the mining stocks, but I run it by someone before I bring them on to make sure they're at least like good management team, good company, you know, a junior miner. maybe they find it, maybe they don't, as long as you understand the risk. But, you know, there's some of these companies that are great, but how do people know about it? I mean, I'm doing
Right.
it like
And,
full
you know,
time, and like people are sending me stocks. They're like, "Hey, did you hear about this silver company in Australia?" I'm like, "No." I was like,
so the word I heard was that MUX was targeted. You know, they had like 12 times the average volume, and they're 16.5% short on the float, that they were one of the targets. So would you, in this environment tomorrow morning, be more inclined to, again, go to the more speculative side, or the ones that have the greatest visibility, is what you're saying?
yeah, I get it. It's actually a great question. From that standpoint you're asking, I mean, I don't know. For me, I have like my basket of silver names that I look at. You know, I'm somewhat familiar, so that's a factor in there. But I would say that probably you'd probably want to go to First Majestic, at least for that parameter, over McEwen. I would guess the people that know about McEwen are like, if someone puts on an iron condor in McEwen mining, I'd be afraid of that. Because you don't find, it's like silver, like, you know, right now the attention's getting out, but that's why silver it was kind of nice. It was like we had our own little club. You really got to do a little thinking. You got to break out of that Keynesian corporate, go to school, get good grades, college, be a slave, white picket fence, 2.3 cars. You have to like do a little thinking outside the system to get to silver. And I'm highly generalizing here, but I'll bet you had. So if you think about like a poker room where you don't want to go where the pros are playing, you want to go where the guys on tourist. You know, you see the guys like drinking, like throwing in $100 before they even deal the cards. That's where you want to be. And I would guess that it's like people who can't even spell silver. They're going to know, oh, First Majestic Silver is GameStop. Let's pile in there. So yeah, you'll probably have a ton of speculative money in there. I'd be a lot more afraid of an iron condor in McEwen mining than First Majestic. Does that answer your question?
Yes, it does. Hey, thanks. Other guys want to ask questions. Keep up what you're doing.
All right. Well, thank you for being here, Dwight. Sure appreciate that. And Luca, do you have a question, sir?
I do, yes. First, I want to say thanks to everyone helping out and answering questions. I'm not sure how appropriate this question is, because it's not really.
Sounds like a good one already.
Well, I guess I'll cut to it. How much thought do you guys put into the Basel reforms as a catalyst for the precious metals market? And do you see it? Well, I guess if you see it as a catalyst, what kind of price increases are we likely to see?
I'll let Rob give me a second and I'll let you take that one. I know that you've dug into that. I don't know why, but it's like, I know other people feel differently. Somehow it doesn't register for me. I don't know. It's like, maybe I just don't understand the BIS or what they actually do there enough. It's like these guys are always changing rules, or what was that stupid thing they were doing a while ago? Not Swift, or what was that alternate currency that Jim Rickards was always talking about, that they were thinking about ramming down our
SDR.
Yeah, the SDR. So I guess as I'm thinking about it,
which is now defunct.
I may be completely wrong, so that's why I'll let Rob answer, because I know he's dug into it more. For whatever reason, it hasn't struck me as something that is on the top of my mind. But Rob, what do you think?
So Basel III is basically the requirement set out for participating banks as a result of the financial crisis. There's a lot of stuff in there, but there are a couple of liquidity measures that are pretty important. And with respect to the gold market, the NSFR, the net stable funding ratio, is the one that's started to get a lot of attention, because the LBMA, which is an unallocated gold market, and where the NSFR comes into play, and anything that's like an unallocated or derivative market is subject to NSFR, which is basically 85% backing. That's a really tough requirement on a derivative market. So the LBMA falls under there. So they posted something on their website earlier last year about they were panicking a bit, saying it's going to raise costs, it's going to reduce liquidity, so on and so forth. And I did some digging, and they'd gone to the Fed and they'd talked to the European Banking Authority, trying to get exempt from these Basel III liquidity requirements, and it was a no-go. And so they were trying to negotiate, hey, can we maybe change it from 85% to 50%? I think the European Banking Authority said, we're going to give you, we would, they felt like they would discount it to 15%, whatever the inventory numbers were, because there was some sort of data issue. The LBMA data is kind of hard to get to. It's not really robust like the COMEX, because it's basically a bunch of private contracts. And so anyway, so the LBMA provided data, but it didn't really alleviate the situation. In a nutshell, what it means is a lot of the bullion banks can't back their derivative positions with like 85% gold. So I guess they could do it with cash, would be a substitute if my understanding is correct. But the speculation is that, well, not speculation, LBMA said a lot of the bullion banks would have to exit that market, and that would reduce liquidity. And it's one of those really opaque and complex markets, but essentially the derivative, there's more derivative, there is gold, obviously. And so they use the derivatives to facilitate exchange. They do swaps and things like that. Swap is basically like selling forward. So I mean, essentially what it would do, they'd have to increase their cash position to support that market, or they'd have to increase the amount of gold they have to support those requirements under Basel. I think there were 3 banks that came out last week or a week before. There were 3 banks in Europe, and I don't remember which ones, which are going to comply early. So that's going to affect the amount of bullion bank availability in the LBMA. So what all of that essentially means is some of that derivative trading has to go away, or they're going to have to put a lot of cash behind it. But it's going to affect the entire supply chain of gold, apparently. So it should raise prices quite a bit. It should reduce the overall amount of derivatives traded over there. Maybe it'll bring some clarity as to what their inventories actually are. There's been a lot of work by Rhoda Manley and Bron Suchecki and Nick Laird in the past on how much gold could be available. But what we suspect is that there's X amount of available gold allocated, and there's a whole bunch of derivatives on top, and Basel III would expose some of that, I think, is what the LBMA is worried about. And the LBMA is also afraid of the cash gold markets, like in the Middle East, like the Dubai market. And they sent a letter to all the gold exchanges across the world, including the COMEX, but they're really focused on Dubai. And they were criticizing cash trading because I think it threatens their model where you have cash trading. It's not a derivative, right? So it threatens their unallocated model. I think they're afraid, partly because of Basel, that people are going to go to other markets like the Shanghai and the Dubai markets and COMEX.
Sound good, Luca?
Yeah, and if I may, one last thing. When is this supposed to be, I guess, a widespread reform? Is there any set dates or?
Yeah, according to the BIS, it's supposed to be June 28th of this year. The NSFR, there's 2 different liquidity measures. There's a liquidity ratio and NSFR. The NSFR is supposed to be June 28th. Now, I've gone back and forth on this because that's what I originally reported, and then people were telling me it's January 1 of 2022 for the UK, because the UK government and PwC, their auditor, released documentation saying they're not going to comply with that specific piece of it, as well as some other pieces, until January 1. So I don't know. I know, was it Andrew Maguire who said he still thinks it's June 28th of this year, but it's cloudy and murky. Like I said, some European banks are complying with it right now. They decided to comply with it early. Anyway, so it may be this June, it may be January. I don't know what enforcement authority the BIS has over that. That's one question. If somebody doesn't comply, what type of enforcement they have. I'm not an expert on that.
Yeah, that was great. Thanks, fellas. Appreciate the help.
All right. Thank you, Luca, and thank you, Rob, for the answer. And thank you, Neil Silver, for being here tonight, even if he's taking a little, I think we may have knocked him out over there. Neil, good to see you, buddy. How are you? I think Neil is muted there, but it's we do have someone actually named Silver in the chat tonight. Neil, would you like to say hello to the crowd? Neil's already trading his options before the market opens. So, Neil, I can't hear you, but good to see you, buddy. So, welcome. And Alex, did you have a question?
Yes. Thanks for doing this again, Chris, Robert, and
You're
everyone
welcome.
else. This is very much helpful for me to understand the market said all this gold behind me, which is not mine, but I found it somewhere else.
Nice.
So the question that I have is, I personally see this like influx into silver as a good boost to where the floor should be, which I believe is around 50 to 100 or so, around that range, because of how some of the hedge funds are already saying that there should be $50 silver. And when the Basel III rolls around, it should be around 50 to 75, 100 at the highest. So in my mind, in question is, since we have the gold and silver ratio going below 60, like below 7, it should be 65. And many people are saying like take some profits for like many older investors who have a ton of silver and convert that into gold. Should we go by the mining ratio, which is around 15 to 1, or should we wait till it goes a little bit overshooting? Or should some people take some profits now? And how would you recommend that, especially for people trying to get into this?
All righty. Well, thank you, Alex. I am pulling up the gold to silver ratio chart here. And Rob, you can prepare your answer for this and tell me what your thoughts are. I mean, the gold to silver ratio is where is what makes sense. I don't know what scale is this by the day. Well, we'll stop that one. But I mean, basically, I remember seeing a chart. Actually, didn't I have that? I will see. But that the gold to silver ratio stayed around like 15 to 1 for a couple hundred years. Then it seemed like right around when the Fed was invented. Do I have this thing? Oh, there we go. All right, I will pull that up. You know, it basically went nuts in the last 100 years. I'm sure there could be a variety of explanations for why. But I mean, it's like, I guess, like, Alex, how long are you prepared to wait? So, like, let's say you think it's going to go down and tomorrow the markets get wacky and it goes to 90. Like, I don't know. Maybe you have to wait a year.
I'm fine
maybe
with having the negative. So I'm fine with having the negative carry for around 30 to 50 years, because I know that eventually the comics has to default, like no matter what. And even if they try to shift to the LBMA, which I had to thank Robert Keene's research for that in understanding that, they still are going to default, or they had to self-default and have a floor of credit just to keep up a general liquidity price. So I personally am just fine with having that negative carry, because no matter what, where else am I going to get undervalued assets like these? Like when you have GameStop that's almost half of, like almost more than the price of a sovereign here, like it makes no sense to me, and why I shouldn't just invest in the sovereign, which I know has more upside potential, like uranium.
I mean, I'm on board with uranium. I don't know. I guess if the gold, when you're talking about gold to silver ratio, are you talking about actually swapping gold to silver? Or are you talking about some sort of derivative trade you're putting on?
I am partially thinking about doing derivative trade to catch the volatility of it, but I'm thinking more about
the
physical
specific
swapping.
trade you're looking at putting on? Like what actual securities are you buying or selling in this pair trade?
Well, I am thinking about buying securities in SLV, specifically with having one short and two calls at this like $1 spread, and just going from there, so I can catch the volatility, implicit volatility, and from there I can then take that to then buy like call options to get standing on not the GOD, but another like derivative security for the paper end. While the physical end, I'm looking at the gold silver ratio to actually trade the physical metal.
Well, I guess my response to that is that I don't know. I mean, gold to silver ratio, as you can see here, isn't the kind of thing that responds to logic on a weekly or monthly basis. So if you're buying call option packages or, 1x2s in silver and then doing something else in gold, I don't know that. I mean, it just, to me, it's like you might have to wait like 10 years. And if you're dealing with options that expire in 2 weeks or 2 months, I don't know if that's.
Yeah, I'm doing ratio spreading and doing for like longer term expiry dates, so it can capture the implicit like vega.
You're just, I mean, I'm not saying that you can't put on a trade that would work, but I mean, if your underlying premise is the gold to silver ratio, it's like you're involving a whole bunch of other elements in there that I think are getting away. It's like, that's why, when I said before, and I think someone was saying, when we're going to talk about options, like, to me, that's where, I mean, now there's different things. If you're going to go be a market maker, then you're going to look at things differently. But if you're saying you think the gold to silver ratio is mispriced, and Matt, maybe you want to comment on this, but if you're saying the underlying premise, you think the gold to silver ratio is coming down, if you told me like, all right, you want to swap your gold into silver, all right, I think that could make sense. Like, there's no guarantee, but like on a probability basis, I think the math supports there's a good case to be made there. But that, would that pack, like doing 1x2s and SLV versus GLD on something that I would think is not going to be reflected in the short term, would not be the way I would first look to express that. Matt, do you have any comment there?
No, just to go back to the trade that he was discussing, that's essentially a form of a modified reversal. And it's a good example how you can buy and sell options and create an exposure for yourself with less cash going out the door. So he's talking about essentially selling some level or amount of puts, using the cash to go out and buy calls. So he opens himself to downside risk of price, but he captures upside. It's functionally the same as buying the shares and being long, but you don't put as much cash out the door. So, it's one strategy, even given the current environment that we're seeing, where things are very volatile, that it's still quite effective because you're not having to expend or send a lot of cash out the door to create an exposure for yourself. So I just wanted to kind of touch on that for the entire group.
Yeah, and I think that's the part about options that can be great, where if you can find packages, you can arrange things in some good ways. I guess, Matt, do you have any thought about, to me, like the gold to silver ratio? That's something that I don't know that I could expect. I don't know. You could tell me like, almost like people buy this much silver and this much gold over the next week, and I still wouldn't know what the ratio is going to look like at the end of that week. So does that, Matt, do you get what I'm saying there? Of like, if you have something that's longer term in nature, a bit of a mismatch if you're using short-term options on that?
Well, you can pick maturity dates, and I'm seeing like in the comments here with regard to selling puts and buying calls means you're double leveraged. It doesn't mean you're double leveraged. That's incorrect. If you have cash secured puts you've sold, you're not double leveraged. You'll actually be picking up shares at a particular price or having to sell them at a particular price. So, depending on how aggressive you want to be and how much capital you have in your account, you can take that into account when you put that on. But no, with regard to the silver gold ratio, I don't have any view on that. That's not something, especially with regard to options, that I would be taking into account. I would say at the company level, doing your analysis, feeling comfortable. Rob would be able to speak to that very well, especially within mining, and I know you would too, Chris. But that's not something I would espouse a view on.
Yeah, specifically for that, I was thinking about taking the profits that I have from the spread from the calls and puts, and then taking it to a derivative contract that would allow me to hold for delivery for gold once I feel like the market is trying to make a downturn to get a much shorter range, especially during the time, especially June, where they had to increase the gold price, or in when they actually implement Basel III, so I can get that profit ratio where it would go up more and just lock in the price now.
Okay, so just to understand, you're talking about selling some puts, taking the cash, and participating in like a future, going along the future. Is that what you're saying?
Yeah, I take the spread from the volatility from the like calls and puts on SLV, and taking the innate Vega to then go buy option like calls on like gold, like that will eventually go to like June or like July, like the end of July, February, and just like hold for standing to deliver.
Okay, yeah, if you're using the net credit, that is the product of the puts and calls that you buy and sell, and you have a net credit, a positive cash flow into your account, and then you're going out to make further purchases separate from those movements. The only thing I would point out is there's the differential between participating in the futures and options. Options, you never have to post collateral. You just pay the premium to purchase them. Whereas the future, as I discussed earlier, things can change, and they can change quickly. And anyone who's managed a futures desk, augmented with options and forwards, they seem to change when you least like them to change. In periods of heightened volatility, broad, drastic moves. So the only thing I would point out there is if you're going to buy like long calls or something that's self-funded to a certain degree, that's fine, because you're not going to have to take extra margin into account. But if you're then going to take that capital to purchase another derivative product in the form of a future, keep in mind that you might have another cash call on your account down the road if things go against you. And you always want to be careful of that, because if it goes against you to the extent you have to liquidate, it pulls you out of your other positions. And that can be very painful.
Yeah.
All right. Well, Alex, hopefully that was helpful. Again,
that was
all of these things.
Cool.
I mean, well, maybe there's something, but I mean, there's not always one way to do it, but hopefully just, again, the thought process. And what I would suggest, get an Excel spreadsheet, map this out so you're clear on if the stock does this, my payout looks like this. If the stock goes here by this expiration, map these things out. Going through that process of doing it, yeah, I could build something, but if you go through the process of mapping it out, making sure your thing is right, and then you start seeing how the different scenarios play out, is a great way to really get it ingrained rather than just guessing. So anyway,
thanks for that, Matt and Chris. That was fantastic. I did not realize that I need to have expect when the volatility goes against me, because I was assuming the volatility would go with me. So thank you again.
Yeah, you're welcome. Sure.
Well, thank you. And Matt, I think, are you going to be involved with our option program going forward? I know we've been talking about it for a while. Are you going to be one of our teachers?
Yeah, I think it'd be a lot of fun.
Well, that will be exciting. Again, we are, tonight was more just wanted to be here, especially while the market was open. We're going to wrap up soon, and we've been mapping out. So some of these things, there'll be times where maybe it'll just be if I'm free during the day and people have questions about trades, certain calls like this, certain plan topics. If anybody is interested in finding about the option group program we're going to be offering, you can email, let's see, which address should we give out here? Let's say support@arcadiaeconomics.com. If there's anything in particular you would like to have included in there, again, really is just to help answer questions and have some ideas to present. But we're mapping that out. And anyway, so that would be support@arcadiaeconomics.com. Chris, I'm in for the options. Please fill me in. Well, there you go. Guna, it's nice to see you. Email that, and that way we will continue to do some of these open calls, but wanted to design something for people that want to take it a little bit further. So with that said, two last things I'm going to show, and then we'll take a few more questions, and then I think wrap up for tonight. Been a long weekend, a great weekend. So anyway, last time, 2 weeks ago, we took a look at the First Majestic. Remember, does anybody remember we're going out the 2013? So these expire 2 years from now. And if you remember, the highest strike out there was the 25s.
Yeah, $25.
And so now, as you can see, they have added up to the
30.
27 and 30 strike.
Yeah. How much is the premium on that? 1630. Whoa.
Can whoever's talking right now just I'll take questions in a bit. Just hard to continue when a voice cutting in. Thank you. So this will happen as the stock moves. That's why, in fact, I used to, when I was sitting there in my option pit, they would come back. Can we add these strikes? You just add them and price them. But keep in mind, I believe these 25s that we went through last time, I think they were offered at $2.30 was the number we're using in the example. Now, as you can see, obviously the stock went up about $4, but these vols are also absolutely jacked. So if you bought those for $2.30 and didn't hedge it, you have, I don't know, maybe like a 2.5 bagger on that one. You won because the stock moved in your direction, and you also won because the volatility is higher. To show the volatility impact, and remember I said before, options are great looking for comparables. So we were looking at when First Majestic was $11.80, the 1 week out 13 strike call, let's just say it was 11 cents. So, all right, now we can look at a similar situation 1 week out. So we will look at February 5th, which is actually next Saturday, but you know, it's the close on Friday. So if the stock price here is 18.12 and we want to get an equivalent, we're looking at a comp to see if it's priced. Back then, the stock was $11.80. 13 strike was $1.20 out of the money, and we knew the price. So what we'll do here, the stock is 18.12. What would be the strike? That is $1.20. $1.20 out of the money would be the $19.32 strike. Can everybody, Dwight, I see you in my 5 screen panel. Can you nod if that makes sense? You can be the, thank you. Actually, can you unmute Dwight, please? Dwight, maybe you can guide me along here and just give me a yes if you're following. Can we unmute Dwight, please, Rob? Actually, let's see if I can do that. Yara, can you unmute Dwight? All right. Well, Dwight, you can just nod.
Unmute which? I'm sorry.
Unmute Dwight if you can. So the $1.20 out of the strike call would be the 1932, right? So now, obviously, we don't have a 1932. We have a 19 and a 1950. But to show you how much the vol was in that other example, we paid 10 cents for a 1 week call. And actually, the 1950 strike is even farther out of the money. See, that's $1.40 out of the money. You have to move farther. So theoretically, if all else were equal, if the pricing were the same, the 1950, just because it's farther out of the money than the example from 2 weeks ago, that should be less expensive. Yet here, the one that's farther out of the money is like 12 times as much. That is why if you are holding, if you're holding options in First Majestic prior to Friday, yes, you won because it went in your favor, but you also won a lot because the cost, which is measured in what's called the Vega, for each volatility point, how much if the Vega is 10 cents, if you raise your vol from 30 to 31, that option increases from $3 to $3.10. That's why it's a derivative. There's multiple parts. So it's like a moving equation, which if you say, well, isn't that kind of confusing? I mean, maybe not first level stuff, but that's the whole thing. It's like a poker game where there's multiple things happening that are changing. And yeah, I mean, it's maybe not meant to be mastered on the first day, but at the same time, I find something that I've really trained myself at is just wherever you are today, that's great. You're learning. And if you're having fun, fortunately, you don't have to be the world's greatest option trader on day one. Anything that you're enjoying doing in a fun process, having a good time, it'll sink in. And whatever degree, maybe somebody here wants to go trade on the floor. Maybe someone just wants to do covered calls in the most effective fashion. There's no right answer, but again, really what I think can be helpful is the thought process, how to look at these. And, you know, maybe it'll be like a different example, but we're not looking at this degree out of the money call, but you'll be doing something else to be like, okay, how can I find a similar comp? I find most people, especially when they get into investments, aren't good at comparing apples to apples. They're comparing apples to something else, and they're having a hard time making a decision because they don't know how to put it in appropriate comparative terms. That's why I brought up the Fed balance, or we'll leave the Fed balance sheet out. But it's like people say they printed a lot of money. Well, 1 trillion is different than 10 trillion. The degree matters. The extent matters. And that's what's great about options, because really what I target, and again, it's not the only thing you can target by any means, is that if I see, like right now, these options are cheap. But when I bought them last week for 10 cents, I paid 10 cents and you have the unlimited upside. That's the most you can lose. But all right, maybe if First Majestic goes up $4, you'll win a decent amount. But if you ever have that blowout GameStop type move, that's when you get those big multiples, because you have that upside, which again, and not to say that one is right or wrong, but if you do the cover call, that's what you're sacrificing. Imagine with options, there's a fair price to anything. So if you get this, either some guy's losing something or there's some trade-off. In any market, you can think the equilibrium, all right, well, they made more units. So will that reflect in the, okay, well, they have more income. So the net present value of the cash flows is higher. But it's like, and sometimes you don't know where to start from. I mean, all right, so this market's 260 at 280. Is that high? Is that low? You know, and in many cases, you know, when someone was out, I'd have to go over to his board, make a market. Well, I don't know, but maybe I just saw the guy before that was buying the heck out of the 15 line. Well, maybe I'll raise this a little bit because I don't want to keep selling vol there. Again, if you like puzzles, if you like chess, if you like thinking about things strategically, comparing and thinking, well, what I learned from this subject, how can I apply that there? You can learn the technicals of the options. That's easy enough. But again, going back to the thought process. So Dwight, did that make sense there? Okay, thank you. And one last thing I'm going to show, and then we'll take any questions and then wrap up for the night. One thing that I've been looking at that I talked with Matt about, I don't have numbers to back this up. It's a project that hopefully Renron will be able to help with. But here, now this one looks smaller because you had the big move there the next day. But here's 25.10 maybe down to, you know, 40-cent move down. Now, if you're talking about a regular stock, you know, like if Microsoft maybe goes down because they missed their earnings or something like that. All right, there, you know, if there's a tangible reason, okay, then, you know, things do go down. Sometimes they're worth less. But what is interesting here, where now this probably wouldn't have worked as well a couple of years ago, but it seems lately like every time there's that price smash, we've seen a lot of these spikes right back up. Yes, Dwight? We've seen that a lot more often, which I think is reflective of the pressure in the market, and that people are like on these spikes down. It's kind of going back in their face. Can I sit here and say that every time it spikes down and stops, like that's the perfect time to buy it? No, but again, with options, think about, you want to be the casino. Stop trying to think, oh, I'm 100% sure I'm going to make this trade. It's not the way to look at options. At least, I mean, I guess there's different ways, at least from what I can offer. That's not how I would look at it. Yeah, I mean, if there's a specific trade like the silver trade and you want to put something on big, you know, there's certain times to do that. And that's one thing. Yet going back to the money management, I don't know, like as an example, and this is again, not legal financial advice, but just how I'm looking at it. Let's say we wake up tomorrow morning and silver's like $24, is down a couple bucks. In that situation, I think I would do something pretty aggressive because of how I feel about it. So by all means, there's times where you can say like, hey, I have a strong opinion here and I'm going to put something on, I'll win or lose. And that's okay too. There's a right tool for each job, but in something like this, and actually something that I've been really thinking about a lot is that of reducing bet size, making more bets where I think I have edge more often in smaller size. Because if there's one, probably more than one, but one area where I've thought about if I could adjust, I think there's a time to go all in on something. That's how I was trained as a trader. And it's like when you're playing poker, there's time to go all in with your chips. There are situations which dictate that, and that if you do that in the long run, you will come out ahead. But all these things, most of these things, I think about the long run. So if I do this 10 times, usually it seems like it spikes down, then sits there for a little bit. So I think this was the one, Matt, you and I were talking about this on Wednesday. And I remember, and even better, before like whether it's right or not, I think if you take a small amount of money, even if you're buying one contract at a time and just get in the game and test things and do it with an amount of money that is the appropriate amount for you to be testing things with. No, you don't want to take your kids. Well, actually, do you want to take your kids' college fund? Given that the damage that college does, if you speculated all of your kids' college money away on options, and even if you burned it to the ground, but your kid didn't end up going to college and getting indoctrinated with all that junk, interesting philosophical debate, but we'll leave that aside. Don't look, options are already risky enough. And I mean, you can buy some of these stocks, the good miners, and you're going to make a lot of money. So that's my, don't tell anyone what to do, but just they're volatile enough. And especially if you're learning, start with a one lot. So it's like, a small amount that I think is, for most people is not going to break the bank. But in something like this, where, again, if there was a reason that it went down, but if the only reason is that they hammer it, and I think that when they hammer it, there's a good shot of it going up. The way I look at it is, all right, if I do this 10 times, what is my P&L profit and loss going to look like at the end of those 10 spins? As much as and I know I'm a bad example of this at times, but I even forced myself to get away from like thinking of it as one shot. I don't know, unless you're going to like trade once and then never trade again. Even though especially as silver bugs, we don't often see it like that. Maybe guilty for part of that, but I mean, it's going to happen again next week, the week after. So if I say, let's say I had $1,000 that I want to test this with, maybe I'll take $100 10 times, and you can put that on. So here's the best thing about options, and we talked about that last trade from 2 weeks ago. That maybe not even for the specific reasons, but sometimes you get bailed out. So, hey, sometimes something quirky happens. So you don't even always have to be, sometimes you get unlucky, sometimes you get lucky, but let's say you do this 10 times, and one of those times you get a 10 to 1. Well, then you've already broken even. And if you hit anything on the other 9, because if you get 10 to 1 on a $100 bet, you have 1,000 back. So even if you lost all your other 9 bets went to 0, you're still flat. Now, the key is this in the long term, is this, if my theory is right, then it's kind of like if you're flipping coins and I pay you 51 cents every time you win, you only pay 49 cents every time you lose. If we do that 2,000 times, you can calculate pretty reliably what you're going to get. So again, this is something I'll test more, but I mean, there's going to be sometimes, fine, you buy it here and then the thing keeps going down and you're probably going to lose that one. And I think this works a little bit better with short term, but in either case, I wouldn't have done the same thing last week, and I'm not saying there will be a smash tomorrow. I'll be prepared for it if there is. But should there be, at least in terms of if anyone is curious what I would be thinking about that, I mean, I think we're kind of in that red zone where this is really on borrowed time now. And again, to be clear, that doesn't mean it'll happen next week, and expect it to go longer than you think. Expect things to go. You're like, all right, hey, well, Chris said the dealers got shut down. Chris said there are 34 million ounces. So remember, Chris is also saying, despite that, even though I think we're getting where the length of how long that can be ignored is getting smaller, I don't know that it'll be this week. I don't know that it'll be this month. My personal feel is that by the end of February, we'll be seeing a bit significantly higher. I think there's a good chance of a significantly higher price. But just make sure that you're trading in a way that happens, great. If it doesn't happen, you've done the math and you've bet an amount and you've set up, there's different ways to do it, but just set up a plan. My plan, I'm fortunate now I have a business, and there's things growing. And to me personally, like, I feel strongly enough that if I just sit here and buy options and, I burn through premium for 2 years, but I'm wrong, I'm willing to accept that. If I buy silver and shares and it takes 20 years for the thing to move, but I don't know, it's like, I don't want to go out and buy Tesla stock or negative yielding treasuries. But again, everybody's different. Some of you have different parameters. Hey, maybe you're retired and living on a fixed income. So everyone's situation is different. It's not to say do it how I do it, but just last thought of the night, then we'll take some questions and wrap up. But this great book, I think I mentioned last time, is Bill Walsh, the coach of the 49ers. The Score Takes Care of Itself. I love the thing. And I think what it points out is that, yeah, there's that random luck element to life. But, I don't know, maybe while the other coaches were going out drinking beers, Bill Walsh was there until 2 a.m. saying, all right, well, let's say hypothetically it was a 4th down, it starts snowing, my kicker's shoes fall off, and I have to go for it on 4th and 12. What would I do? Maybe it's a rare scenario, but when you're always thinking through all the possibilities, they're not all going to occur. But if you think through everything, and then when the heat is on, remember when things are moving, when all of a sudden your screen's showing that you lost money and the emotion is going, especially options, having a plan in place, having a strategy in place, which is going to be different for everybody, but finding what makes sense to you that matches your personality, that matches your style. Options are great because you can adapt it to whatever that may be. Don't try it. Learn from other people, but just be yourself and mix that in. And if you're interested in doing this more, send an email to support@Arcadia Economics, and we're going to put something together to make it more of an organized process. But with that said, We'll take a few questions and then we'll wrap up for tonight. Anyone want to raise their hand? And actually, I think I figured out how to do that. If they have a question, right, I think that one was Silver Bull.
Yeah, hi, Chris. Thanks. So, I had a question regarding SLV and PSLV. So, I've been reading online that PSLV is a better option because it's backed by actual silver, and SLV also has ties to JP Morgan and stuff like that. So, could any of you comment on that?
Sure. Well, I mean, SLV is supposed to be backed with silver. There's a lot of reasons to suggest, and I mean, I say this in that I hope that we don't find out one day that it's not there, because obviously that would be not ideal for people holding SLV. I mean, there's legitimate risk factors. I wouldn't own it. I don't know. I bought some options on it. I mean, it's like if you're trading something for like a couple of days, but if someone wants to own silver, whether it's just for their own protection or they want to try and squeeze the market, either getting physical, or I would feel comfortable with the Sprott trust that your metal is actually there. I would check the audit reports, go through them yourself. I think it's good. I didn't put money there. I haven't gone through everyone's audit report. I mean, I know people there. So like you mentioned, SLV, the custodians, JP Morgan, you know, I find in general that when I surround myself with people who really care about me, you know, are smart people, they, you know, it's like people who treat you like family. They're going to look out for your best interests, even the times where maybe you do something that's not the most well thought out thing. You go over to JP Morgan, you know, you're not getting everything right, and they're going to scalp you any second they get. So it could be that maybe the metal's there, but, you know, when you try and sell your shares, they're like, oh, well, we just decided to create a new 20% tax. I hope that doesn't happen, but that's the kind of things that bankers do. It's the same with, as much as I hope, you know, we wake up, we could, I mean, I guess I've tried to be careful and not get, you know, I try to always phrase these things. I know people don't want to get anyone blown up. We could wake up tomorrow morning and see silver at $35. I think we're in that time where anything's possible. So there's a lot that could happen, but just, I mean, if the whole point of getting silver is that you think there's a short squeeze, you think there's leverage, anyone who's asking me, like, I would just think there's risk with that SLV. It may turn out to be okay, but it's a risk that you can hedge out. It's like, if I ask you, like, hey, you okay if I throw some grenades in your front living room? Maybe I'll miss. I mean, maybe it'll be okay, but it's a risk that's unnecessary. Hopefully I made someone giggle with my silly analogy. But anyway, Silver Bull, hopefully, does that answer the question?
Yeah, thank you.
All righty, you're welcome, sir. Let's see. Does anybody else have any questions as we wrap up here? Or if anybody does not have any questions, but just would like to say anything or had a really fun day or had some thoughts that they would like to share, go ahead and raise your hand too and say hello to the group. Or how about Sebastian? Can we unmute Sebastian?
Yeah, I just had a quick question regarding volatility or implied volatility. So I'm definitely new to options trading. I was just wondering, with the recent spike in price, it's definitely going to affect the premiums, which is going to in turn affect the break-even price.
Mm-hmm.
How long does it take for implied volatility to, I guess, drop down a little bit? And would it be worth taking that premium hit or wait till, or I guess depending on how long the implied volatility takes to come back down, buy and then?
Yeah, that's a great question. It's kind of like how long until it rains. You know, all depends. Yeah, there's a case to be made. I remember I was thinking what to do because I had the First Majestic call options on. There's a part of me that's like sitting there now. What I'm balancing is that, all right, there's a chance like if they do a short squeeze on First Majestic and it does something like GameStop, then even as I mean, we looked at those calls. They're darn expensive right now. If it goes a short squeeze, you would still win huge. Now, if it, but it was kind of like more expensive. I wanted to find something cheap to buy because there's part of me that was like shit, what if we're really here and about to see some wild stuff? But I mean, that's kind of how it's going to go, and which is actually the opposite of the typical skew. Normally, the out of the money, the equivalent like dollar out of the money put will trade over the dollar out of the money call in your regular stock. That gets inverted on the silver stocks, I think, because people know like when they move, they can move quickly. So those upside calls right now, they're incredibly expensive. That's why there's like part of me that's hoping if you saw we wake up instead of silver being up $1.50, if it's down $2, A, the spot price is lower, but B, that's what you would probably see the vols come in. But if you see First Majestic up $2 tomorrow, and let me pull up because fortunately Will's great site has a bunch of different stuff. I would say check out the Market Chameleon. And let's see, volatility. So here is the implied vol. So you'll see the implied vol without having looked at it. I'll guarantee you it spiked the last 2 days. And sure enough, there you see it. So really when you're buying options, because you can hedge out the directionality, really what we thought we were buying and selling vol. That it's hard. Because if the option, you know, you can, let's say you hedge out the directionality, you're thinking about the straddle. Straddle of a utility company, solid cash flows doesn't match much, probably smaller. Straddle of similar price. Tech stock, you expect more volatility. That will come in, that will go out, as you see here. This isn't the stock price of First Majestic, that's the volatility. So this thing spiked. That's why, similar to what I said in one of these calls today, if I'm repeating myself now, bear with me, but like I have a friend that bought a bunch of puts right before the market crashed for Corona last year. Here's the thing where I think is actually, the more I think about it, it's kind of like a little bit of an anomaly that I don't think people notice, but it's like if you buy the puts when times are normal, then the thing goes down a lot, the vol gets jacked after it's gone down. People are pricing because like if you buy the puts then the vol is already high, so your price that you've just had the monster move, if you buy the thing then you need like, you can win, but you need to have like another probably bigger move because the vols are jacked. So essentially that's what I've been training myself on, is that when, you know, because it's tricky, especially you guys know how I feel about silver. I always think it could be close. So when in silver, First Majestic is up $3 tomorrow, there's going to be that part of me that's like, oh shit, well, what if it keeps going? Yet really, that's kind of the time to sell. And at least what I've been toying with now is not that you have to sell everything, but I don't know, if I had like a 20 lot, you know, I had a couple of, I think I had like a 25 bagger on one, or I think I may have hit a 35 bagger on a, you know, and so it's like, all right, you know, if it's like 40 contracts, you know, I'll sell 2 here, sell 2 or 3 there. I'll pick up a couple more if the price gets smashed. So I think there's a degree to scalp it. I find it's easier if I keep that in 2 separate buckets. Like, here's my long-term stuff. So no matter what, I have my silver, but here's my trading that I'm going to do. But again, it's like I've thought through what matches me, the preferences I have. There's no right answer, but in terms of, let's say you don't think there's going to be, okay, let me put it like this. Let's say First Majestic's up $3 on Monday, but you don't think there's going to be a further short squeeze. That would be the time to sell those calls. Because then, see what will happen, and I guess to answer, sorry, it took me a while to get there, but to answer your question, the vol will come in the day that First Majestic goes down. These vols will get crushed. So for example, even if First Majestic opened flat tomorrow, you'd probably see the vols come down. So if the stock price didn't even move, you would lose money most likely if you're long the options. You can see that if you look at the value of puts, because like once the market then, when during Corona, it was going down. Then when the vols were jacked, but then they had that one day where it goes up. Not only is there the spot price that's being affected, but the vols come in and you get hammered. And 99% of people that trade options don't even realize that vol it's not the only part, but if you had to start somewhere, it's the most important part. That's what's underlying the heart of all of this. And I would say if any of that made sense, just that you're thinking through these things. Don't worry if you get everything crystal clear tonight. Watch this again. This will be on library. Go back, watch the other one. I know this is where we're almost here 3 hours now and 3 hours there. But just imagine any course you're studying in college, to really trade options. I don't know. I was there 7 years. Matt, you've been doing it however long. Anything, if you want to play chess. And here's a tip. If you're listening to this stuff, like what we've talked about for the last hour and you're bored to tears, that's okay. But then don't trade options, because if you don't, that it's like any subject. If I want to be a basketball player, but I hate dribbling or playing basketball, it's going to be hard to get there. But for me, I don't know, if someone gave me $40 million tomorrow, I'd still wake up and, I'm not going to stare at the wall all day. I'm intrigued by the silver thing. So the days that it's tough or you don't feel like doing it, you're able to get through it easier. So I would say that with options, again, I know these are complex concepts, and I'm really impressed. Everyone, when I asked, or you get into stuff, and it seems like people are, and if anything moved quickly for anyone on the call tonight, don't feel down about that. Just pick a time, watch it again. Some of this stuff takes a long time. It's not simple arithmetic. So I would say that anytime you're learning and asking questions is, in my mind, a great thing. So anyway, hopefully that was helpful. Sebastian, Yara or Rob, do we have any last questions here? It's almost time for, actually, how about this? Well, do we have one? Samuel Cooper, why don't you go ahead, sir?
I just want to say thanks. I was really confused about a lot of things of how to try to play the short squeeze if I don't play the options. But I do understand the importance of silver. And after listening to you guys for the last few hours, I got a plan to make a play, not necessarily with the options, but continue to get some physical and pick some good minds for silver money. So just really appreciative to you all for having this type of conversation to help a guy out. Thanks.
Well, thank you, Samuel. I appreciate you being here. I'm getting a little feedback from somebody there. If you could watch your mics, everybody. But yeah, glad you found this helpful. Again, creating something people who want to take it a little further. If you'd like information on that, email support Arcadia Economics. And as we get that together, I know I've been promising it for a while. hopefully it's a little easier for people to see now. We've been doing a lot of different things, planning a lot of fun things, but it's really nice where last year was kind of getting things in place a lot after a couple of years before that of getting things in place, although it's nice to have the foundation now and the way things are. Yar, would you say we have some fun ideas planned for this year?
I think everybody's going to have a lot of fun with our ideas this year.
So
2021 it's more fun in 2021.
So I'm going to close questions for now, although that does not mean you can't still participate. If somebody had a fun time following silver this weekend, or if somebody has anything else to share, even not related to silver, just anything they're happy about, I think it's always nice to just be together here and celebrate the good things that are happening. Hopefully it was a fun weekend. Anybody have anything that they would like to share? Who's got some good news? Come on, we have silver up $2. There's got to be someone. We even saw Bill Murphy smiling today. So somebody tell me their favorite thing about silver or life in general this weekend. And who would like to go? Who would like to do it? Well, I will go. I will take. Or Yara, did you want to?
I would like to just express how much I appreciate everyone who's come together for, gosh, multiple hours a day over the last few days to learn, share, create community, and celebrate together, you know, something that we all see something in that maybe other people don't see yet, but are learning about, and that's something we're celebrating. But I just want to celebrate all of you, and also to personally thank Chris for spending so much time sharing all of the breaking rapid fire news that's been going on, and just for hosting these great events, and Rob and Matt and all of the great experts that have come on, but also, you know, everybody who brought their great questions and brought their interesting, you know, their interests and their energy, and it makes a difference. And I'm just honored to be a part of it. And I learn so much every time we do this. And I want to thank everybody who's a part of it, but especially you, Chris, for making all of this possible.
Well, thank you to everybody. Thank you, Yara. Hey, there's Michael. Are we gonna get a little piano tonight, buddy? How about that, Batman? I'll play a song at my piano.
And thank you, Michael, for giving us the up-to-the-minute AppMex updates. Michael's been tracking multiple different product availabilities over the last few hours, and so he's been keeping us updated as the night went on.
It's been quite interesting.
Yeah, it has been.
Somebody else we have to recognize on this call, very important dog.
Waffles! Hi, Nibbly.
Dog. Nibbles, say hello.
Hi, Nibbles.
Nibbles is all silvered out from today, as you can see there. So let's see, maybe we'll step in. We'll finish this off with some of Nibbles' buddies there in the background tonight. But yeah, just one last thought. Oh, and by the way, I just see a Twitter message. How could life get any better? So if anyone has not had enough silver or like listening to stuff today, apparently Jim Willie is about to go live with Jean-Claude on Beyond Mystic. And I can't even imagine what Jim will have to say about today. So a few closing notes here. When I left Wall Street, it's more just trying to learn marketing, although I ended up going to these workshops. It wasn't Tony Robbins. It was a different one similar to that. Although one of the things I noticed, it was like often, you know, I was still detoxing out my negative energy from being on the trading floor. And it'd be a crappy mood often when I got there. But similar, I don't know, you feel sometimes at a festival or any retreats where, especially the end of those 2 or 3 days, and you've spent time with people and you've bonded over something that you have a shared interest. And that's kind of like what this weekend felt to me. Like we were at a club and together, and it was quite special to see the, people are now tuning in and building our tribe, and to be here tonight with everyone and talking about these things. And yeah, I think I like to think we're going to do well financially, but in the end, hopefully you're keeping in mind and talking with other people, because we didn't have any money, but we had the intellectual power of everybody together, and you just organize that a little bit. I think that's the better hedge even than silver or anything like that. So with that said, folks, I thank you all for being here. Hope you had a wonderful weekend and a wonderful night. I'm sure nobody here is going to check the silver price tomorrow. Everybody's probably going to be, like watching paint dry, nothing exciting going on. Perhaps last thought, I do think we are really seeing a historic piece of history right now. For whatever reasons, whether there's influence, political or not, to me, I think there's something wild happening that I'm darn glad to not only get to watch and trade, but share with you guys. So thank you everybody for being here. Have a great night, and who knows what'll happen tomorrow.
All right, we are live on YouTube. How you doing, Chris?
I am well, Will.
Thanks for joining us on marketchameleon.com webinar with Mr. Silver, Chris Marcus from Arcadia Economics. We are starting our Zoom presentation now. We had 1,000 registered for this because of Chris's background in the silver trade. And Dee, thanks for joining us. Good to see you. Chris?
Thanks. Well, I'm going to keep myself. I have background noise right now. There's an alarm bell going on. So I'm going to keep it on mute while it's on. Once it comes off, I'm going to unmute.
Perfect. Chris, I'm so glad we got you. And we only have Chris for half an hour because he's super busy right now. Anyone who hasn't been following Chris, we've had him on probably 5 times since we've been in business. And he's been talking about this silver potential for probably 2 years now, 3 years. Chris, you got to remind me how long.
We're on year 10 on that part, buddy.
It hasn't been 10 years that we've been talking together, though. Yeah. I think at the most it's 3. Anyways, Chris,
you've been putting up with me for 3, so that is true.
Chris helped my retirement fund because I bought a little bit of SLV when I first talked to him, because I was like, I better have something in my account. And I think it's up, I don't know, 200-300% since then. But
you're thinking about converting that to physical soon, Will, right?
Who knows? Who knows? But we've got participants coming in. This is a Zoom-led meeting. We are also on our YouTube Live, our marketchameleon.com channel. So for everyone on Zoom, put your questions in the Q&A or the chat on the YouTube Live. Just put in the chat, and I will try to get to them. Tonight, we are going to be tight for time. So, Chris, start by telling us a little bit how you got into this trade. What made you first look at it?
Well, really that after I was sitting on the American Stock Exchange and then New York Stock Exchange equity option market maker, and then hit me one day while the whole subprime bubble was melting down. I just graduated from Wharton's MBA program, was working on the floor. I'm like, gee, aren't I the guy that was kind of trained to see this stuff in advance yet? I was as blindsided as everybody else at the time, which I don't think is an accident. Maybe that's what the system teaches yet. Fortunately, I was thinking, well, all right, Bernanke's saying subprime's contained. He couldn't spot it even as it was happening. And then I started hearing, well, there was a couple people who did see this in advance. And most of them talked about gold. We saw the movie The Big Short, where you saw what they looked at. And really, it led me to Austrian economics, understanding what Wall Street and Wharton don't teach, what I think is actually a lot more important than what they do teach. And if you like gold, I don't know. I think if you like gold, you have to like silver, and it was just been fixated on it because then in 2011, by the time QE2 started, I'd been trading equity options for a while and was researching into gold and silver. And so I had some big option positions on GLD and SLV, which on the way up was a lot of fun. On the way down was a learning experience. Yet that was 10 years ago, yet I was left thinking either because something didn't add up. It didn't make sense to me why the price came down. Well, basically, I mean, you could call QE2 hyperinflation, let alone what we've tacked on now. So essentially, I thought either A, there's some explanation I can't see, or B, if natural demand was driving the price of silver to 50, and the only reason it got hammered was because a bunch of banks that Department of Justice now officially labels criminal enterprises just sold a bunch of paper silver that they don't own. And to the degree that many experts feel it's leveraged as much as 500 to 1. We can talk about some of the metrics there. But I thought if that's the only reason it went lower, based on my studies of markets, my experience trading, and study of history, is thinking, well, I guess for the last decade, I was left with that seems like the floor. I don't really know how you price something when it's that distorted, but that's where it began, and you can take it from there, I guess.
So when you first thought about this trade, I mean, you've been talking about it for a while. Did you ever see like this populist movement coming from? I mean, they're talking about Reddit now, and people getting in because they want to, get it back at the man. Is that the trade, or is it literally that you thought fundamentally the uses for silver, the need for silver would drive prices? Is it a combination of the items? What is the reason that you first got into the move? And more importantly, I guess for chameleons, at least for me, this chameleon, is where do you see it going from here? We just hit a 52-week high in SLV. I mean, Dimitri and I were looking at unusual option volumes on Friday, and we both kicking ourselves because we saw, I don't know, 2 or 3 of the miners had some crazy call activity. We did nothing, sat on our hands, and they were up big this morning, I think. Was it this? Dee's got background noise, but I think it was this morning we talked about it. So, I mean, is there upside from here? Was this the move? What are you thinking?
Yeah, well, some great questions in there. I think there's a lot of upside. I do think we've entered a new phase where I don't think this is reversible at this point, which is not to say we'll have $50 silver this week, but I'll explain why there. Although one thing that I guess since we're talking options here, would be well worth pointing out, and I'll pull up our silver chart today so we can take a look at that as we go. But Will, I know as you're well familiar with, and some others who have studied options, today would probably not be the day to buy call options. If you're of the view that there is a long-term move coming, or even shorter term, because right now the price of the silver price or the SLV or the miner stock price is higher, but also the vols are extremely jacked. We can pull up the First Majestic board. It's funny, I remember a couple of weeks ago we did a webinar and someone asked about getting the long-term options. They have 2023s, which expire 2 years from now. 25 strike was the highest they had. I remember because we were looking at it, and I think I paid $230 on those. Now I think those are like $9 or $10, and they've added the 30 strike. So if you're betting, especially and it's interesting, vol surface, Will, actually, maybe if you want to pull up the board, it'd be interesting to take a look at, because front month vols are incredibly high. And so right now, if you bought call options today, it's not that you can't win, but it's like you almost need a massive move, because the way, and Dimitri, I'd be curious your opinion on this. I never thought of this when I was back at Susquehanna, but I've been thinking about it the last couple of days in particular, and reflecting the last couple of years, where it's like the way volatility gets priced is kind of an ineffective lagging indicator. Because let's say we wake up, something happens tonight and futures are down 5%. Let's say that, silver gets out of control and people are worried about some of these highly leveraged banks that short silver, which might be a good thing to look into. But let's say, the market's down. When the market opens here in the US, the price is already down, but the vols are jacked. The vols are high, but it's like you're paying that level for what just happened. So if you buy the vol then, in fact, that's kind of when I like, well, I'm working on getting a setup where I can sell vol again, which will be fantastic. And Will, can we talk more about that offline, please, sir?
All right.
But Dimitri, do you get what I'm saying? Where it's like, because if the stock market's down 5%, it'd be great, yeah, if you could pay that vol before the move, but it's already happened, and now it's actually, again, not legal financial advice, but often a good time to sell because that's when the volatility is jacked. And unless you have another move even bigger than that, that's when selling vol. And inversely, the same concept would apply to the call options. And you can pull up the Bart and look at that. Dimitri, any thoughts on that one?
Actually, before we go any further, I don't know if Dima still has this background noise, but D, we may want to go through the disclaimer. We forgot to do that at the start of the show. I'd like to hit that. What do you think?
Yeah, like I said, I might mute it just because there's an alarm that's going off.
Yep.
Back and forth. So I just kept myself on mute so you don't hear that. But yeah, guys, we did forget the disclaimer that, Will and I, Chris, Market Chameleon, we're not registered investment advisors or broker dealers. We're not telling you what to do. We're just sharing our ideas. If you need professional help, call your broker. That's what they're there for, to help provide you with guidance, help answer your questions. So there's the disclaimer.
Perfect. Well, thanks for reminding me, Chris.
May I add something to that disclaimer, Will?
Yes.
By all means, this is completely different what we're talking about in this particular moment than buying physical silver. I'm happy to take questions. And Will, I know you wanted to open it up to questions as much as possible today.
Yeah,
we take option questions, and it's an incredible way of speculating, but it's for most people, it's an unsuitable level of risk, and I don't want to make any confusion about that. But with that said, now if you want to talk,
well, I guess one of the things that I heard, and they had on CNBC today, they had silver dealers on who said they cannot get access to silver. Why is that happening? I mean, is there because Dimitri and I talked about it. We were looking at the fundamental, and silver is used in so many industrial products. It seems like very strange that all of a sudden, just because there's this quote unquote short squeeze, I don't even know if it really is a short squeeze, but this interest in demand that kind of is flowing off of what happened with GameStop, the Reddit group, AMC, and now has seemed to migrate to silver. Why is that affecting silver to these bullion dealers? I didn't really understand that.
Well, I'm looking for something that pull up here. And Dimitri, could I grab the screen share again?
I think you have it. I don't think I have the screen share.
Everyone's got it. You just go to the bottom and it says share screen.
But I'm not sharing. Am I sharing my? No. Who's sharing the screen? Will, you're sharing your screen.
All right, let me stop my share.
I got it.
All right.
You guys see the Twitter feed here?
Yep.
This woman shaking her toilet paper around. Reason I pull this up, Will, I think you know this. I have a partnership with Miles Franklin, which is a precious metals dealer. So this way, at least, we're not people wanted to know they're getting metal. That's where we send them to. So I asked Jana Scheckman of Miles Franklin, who is the co-owner, if today was far and away the most silver they've ever sold in the history of the company. And she just wrote back, it's like toilet paper in 2020. I can confirm my partner, Yara, who handles that part of the inquiries we get for silver bullion purchases, we've had to have someone else take over because it's just too much. So let's see if we can pull up another data point here.
I mean, does that seem odd to anyone else or just to me? Dima?
What's that, Wills?
Well, there's all of a sudden, it seemed to me that it was like a Reddit commentary about the shorts in SLV and the gold, not like some sort of squeeze on the precious
I mean,
metal.
I think that added to the pressure of it.
Yeah.
But
That's
what
how
I
you
believe
squeeze
is,
them.
Yeah.
Yeah. But I don't, I mean, I think that there is fundamental reasons why silver is going up, just for the same reason we're seeing even the digital currencies going up. Is I think that there's right now going to be a lot of pressure on metals potentially. This is my opinion, like you said, because the amount of money that we're pushing out right now is an incredible amount of money that they're just printing. Like this isn't the same as because we have the world economy kind of slowing down, production going down, and so you got more money, less goods being produced, and their solution is to print more money every time. And I think we've seen this kind of inflation before, even in the U.S. We've seen hyperinflation, and Chris, what would be interesting is that silver, it's not just a hedge against inflation, but this is actually used in manufacturing in a lot of products. I know, I've been reading even and you mentioned this before, in cell phones, semiconductors, so solar panels, almost everyday products that we use and buy, silver is an input into those products. So I think that may create a lot of pressure. And the way the metals work, kind of like oil, is like they'll go up, but they like crashed. It's like the opposite way. They could crash to the upside. Like the market could crash to the downside, they could crash to the upside. And that's a little bit different than a stock, although we did see a crash to the upside in GameStop. Yeah. But in commodities, we've seen, that's what happens, and it's happened in history. We've seen it in oil, we've seen it in metals before, and I think that there's actually legitimate reason behind this push in silver. I don't think it's Reddit doing it. Put it this, it would be very hard. Reddit could potentially, I don't know, move a stock that has 5 million or 10 million float, but I don't think Reddit could move the world markets in silver. I don't think that's what's happening. Is that I don't think it's the Reddit message board. I do think that there is a fundamental reason behind this move.
Yeah, absolutely. That's what I've been sitting here telling anyone who would listen for the last 10 years. With that said, clearly there's been some spark in the last week. Now, Dimitri, you raise a very astute point, being the brilliant option trader that you are, that is it Reddit? Is it something else? Is it the attention that's been placed? I mean, we had silver manipulation on the cover of CNBC and the Wall Street Journal. I mean, I thought we had a better chance of finding aliens than ever seeing the mainstream report on this. So, a lot of it, I mean, now it's almost become like a wild media event. It reminds me of the OJ chase, where maybe it's not that big yet, although I think has the potential to be that big because like you mentioned, I don't know much about GameStop. I'm guessing fundamentally it's not worth $500 a share.
Right.
But we saw what happened when something gets squeezed. I mean, on the other case, I think you can make we'll leave aside what a fundamental valuation of silver is for the moment, but, where maybe GameStop to 500 was going against gravity, I would assert that for folks who had a fuller picture of what's been happening beneath the surface, you're allowing gravity just to do its thing by letting silver be freed. Now, I have not ready to share yet because I'm still researching it. I have some thoughts about what could be behind this move and all this attention. I think I'd like to confirm and research a little more. I think I know how I would end up feeling, but that aside, whoever's buying it, I mean, there's hashtag silver squeeze now. I'm seeing like people change. Everyone's tweeting messages to me, and they have silver squeeze in their name and the message. it's like a rock concert where it's like people are talking about silver in the span of days. And again, okay, fine. You could say people talk about a lot of things. What does it matter? Although, I would point out if there's ever been a barometer of psychology, I would suggest financial markets are it. And I might add, this is in the same time period we've seen Tesla go up 19x, Bitcoin 10 to 15x, GameStop 25x in a couple of weeks. So there's, yes, the fundamentals and all these things now, they've been there for a while. Now, while we can debate, what's really behind the minutia of the spark, clearly there's some spark here. And again, maybe none of that really in the end matters, except what are people doing with their money? So I'm sure in the next couple of days, maybe I'll have some more numerical data. But for now, in terms of the physical level, I'd say this is representative of other dealers too. I think that I'm very careful of the way I phrase things. I think that would be appropriate to say. Maybe they wouldn't put the woman dancing with her toilet paper, but that's what the owner of the shop said. And I checked with her. I said, "Are you sure it's okay that I quote you?" She said, "Yes." And I think it's reflective. Another metric we can look at is that on Friday, I was stunned when this came out Friday night. In fact, I'd been, recording, talking silver, making videos all day, and I was just about ready. I'm like, okay, I can't do any more. But then I saw this. It was shocking, and I'd like to give Bob Coleman credit for Bob Coleman, gold and silver analyst, who talks about these issues as well. He was the first one that pointed that out, that how many ounces or SLV, basically, they say they're adding silver to the trust, which hopefully they are. I don't know for sure. I have some questions but you know how many shares were added on Friday? Will, why don't you take a guess on that one?
How many shares or to the SLV?
Yeah, which represents an ounce of silver for each share.
Oh my God. 100 million?
Not that much, although you're not far off. On Friday, and I'll put it in context for you. On Friday, it was 34 million shares added, which means 34 million ounces. Now here we have a report from the Silver Institute. This was an update with their supply and demand. So here we're looking at 2020 expected. This was a couple months ago. So you had the mine shut down last year. So mining supplying the top line.
Hey, Chris, I just want to confirm, because it's we got a question about where you're getting this data from that you're on right now. And I'm looking up top. It looks like the silverinstitute.org. Is that correct?
Yeah, this one, if you go to, you got to search under news and events, Silver Institute press release. And then it's, I believe this one, 2020 release of Silver Institute interim. Now again, then we click here and then scroll down. So they put this out. Let's see, is there a date? November 17th. So yeah, it's about 2 months old.
Excellent. That was super helpful. That was for Jake. Hey, listen, Chris, I want to thank you for inviting the Chris Marcus Silver Army over. We've never had so many people watching live at one time on our YouTube channel. Thanks everyone for joining. Chris is a great friend of the show, and welcome. And if you came late, I will send the video to Chris so he can distribute it to you, and it will also sit live on our YouTube channel, so you can go back and get what you missed. But again, the Chris Marcus Army is on in full force right now.
But what is that? So Chris, what is that? That is, this chart is showing the supply versus the demand metrics year by year.
Yeah, so what there's a couple of ways of looking at it, and I'll share my reaction Friday night, and then when I thought a little bit more about it Saturday was, I think that was a moment I'll remember for years or decades, because when I thought about it a little differently, that was what somehow clicked in my mind, that whatever is happening here, I find it hard to see how it's reversed. And to explain that, here we see total supply in this column, or row here, rather. So 962 million ounces, that's close to a billion. So basically, Will, if you have 34 million ounces, let's round a little bit, times 3 is about 100 million ounces, right?
Correct.
So if that pace on Friday continued for 3 days, that would be 100 million ounces, right?
Yep.
So if you did it for 30 days, would be 1 billion ounces, right?
Seems right.
So just if the SLV, if the amount of shares being purchased at that pace over 30 trading days, you would eat the entire annual supply of silver. 30 days.
Wow.
But then here's what I thought about. It was fun. It was nice. I was calling my mom, and that's right, kids at home, call your mom, and which is always helpful because that's how I always try and think of things. Explain it so my mom could understand it, which forces me to helps clarify it in my own mind. Because I think that they took 1/30 of the annual supply in one day is pretty shocking. But perhaps even more significantly is that when you have a billion ounces here, most of that's already accounted for. So here, 466 industries. So Dimitri, like he said, cell phones. I mean, so you could say we have 1 billion ounces, but if we're going to continue using electronics next year, you're not going to get 1 billion ounces. And leaving aside whether the industrial users, it's interesting to think what they must be thinking as they're watching this and knowing that if they don't have silver, they don't make their products. Apple doesn't make its laptops. Apple doesn't make its iPhones. So we'll leave that aside though. So 466, let's round that up to 500 when you add in photography, 650 with jewelry, let's call it 700 if you add in silverware. So 7 out of that 10 is accounted for, unless we stop using electronics, which I don't think is going to happen.
It's probably going to go up. Chris, would you be able to show us where you mentioned that SLV, when you saw an increase in the amount? Can you show the viewers where you see that information? Like if our viewers wanted to track that and to see if it's in if the shares or the amount
I can somewhat show you. I wasn't able to get their file to download on my Mac the other night, but if you go to the iShares site, you see here download. I'll give it a shot today and see if because what's interesting is that apparently today another asked Bob again right before it came on here. He said another 20 million ounces went in, so slow down a little bit. Anyway, that's where you can find that file. And by all means, yes, please go verify this. Feel free to verify. Although I think we're going to get that thing pulled up here in a second.
Right. In other words, what you could see, it's not just the trading, just so people understand. Because if people are trading back and forth, you might not be creating more shares, right? You're not creating more ETFs. But if there's a much larger demand where there's buyers and lack of sellers going back and forth, what happens is you have to create more and more shares. Okay. And when you do, that's where the ETF has to go out and are they buying physical silver? Is that what happens when they create more shares, or are they doing the futures? What are they doing?
That is the key question, my friend. I actually did call them a couple of years, so at least I could hear someone say, yes, they say they put the metal in the trust. There are a lot of questions, and I mean, I'm not sure how confident investors are supposed to feel when the custodian just was labeled a criminal enterprise, their precious metals trading desk, and fined $920 million for manipulating the treasury and precious metals markets on hundreds of thousands of occasions. CFTC's words, not mine. So they're supposed to have the metal in there. I steered clear of business deals when JP Morgan's involved, and maybe the metal's there, but I find usually when you deal with criminals, whether they screw you in the way you expect or they screw you in a way that you don't see, there's a lot of questions. But if we can leave that aside for the moment, just, and I know then we'll have a couple minutes left, we can open up to questions. Just to finish putting that in perspective, the 34 million. So if 700 is accounted for, and then here you have net physical investment last year was 236.8. Okay. So if we just heard that dealers are saying today that when you ask them, is this the most you ever sold? And they say it's like toilet paper after Corona. I'm assuming this isn't coming down probably this year, especially, I mean, because before even this happened, you have Janet Yellen, who's traded, they threw in a couple draft picks, sent her into the Treasury. And now, even though with the Fed balance sheet at 8 trillion, she wants us to go big. So, I mean, even before this, you're probably going to see some moves this year. I think it's like last year. The things were going to happen. Corona was the event. But these things were going to, it reminds me a lot of that, which we'll leave aside for now. But hard to see this number coming down. And these, you know, we have the Biden green administration, more solar panels, more electric. So I don't see these guys backing off of their cut. Now that adds up to 930. Let's call it 931. So while you can look down here, this 350 number, that's net investment in ETPs, exchange traded products. So at first I was thinking, well, 34 million, they 10% of what went in last year, which was a record year. So last year was a record year for the amount of silver that went into trusts like SLV. By far. Look, you had 81, negative 22, 50. Even back in 2011, it was negative 18. Here, I remember when I interviewed Ted Butler for the Big Silver Short book, he thought that the driver in 2011 was that after Ben Bernanke launched QE2, 60 million ounces went into SLV, and that was what he felt was the main driver sending silver to $50. Okay, last year you blew that away. And then in the first day of the silver squeeze movement, you ate a tenth of what you had last year. But here's the thing. There was a deficit last year. So pretty much if you want to say of the available supply that would be, at least according to last year's number, what would be available for the silver trust if you don't think industry is slowing down, and we see that physical isn't slowing down, that means if 931 is accounted for out of 962, so at last year's numbers, that would mean for the entire year, 31 million ounces would be available for SLV and the Silver Trust. And on Friday, on day one of the movement, you had 34. So you already eclipsed what was available last year. You tacked on another 20 today. And we know we live in a world where funds chase momentum. They buy after things have gone up. And Will and Dimitri, we talked about this before. When tech shares are hot and silver's sitting there, I mean, the fundamentals were glaring in 2011. The money printing only accelerated, but that's where the psychology comes in. Now that it's a national event, I mean, you have Wall Street Journal, CNBC, I didn't know they knew how to spell silver. And now the supply that was available was eaten in a day, and they're buying physical silver like it's toilet paper. So whether that's Reddit, whether that's people who have been watching Reddit, whether that's new hedge funds or investment funds, like I wonder, in fact, I think I'm talking to one of my old friends at Susquehanna tonight. I am darn curious what they are doing, because that's a shop where, you know, if you really wanted, let's say you're like in Will's status, you had like $2 or $3 billion, and you wanted to hire the smartest people you could to execute a short squeeze. I mean, that's who I would pick. And I'm curious what shops like them are looking at, because it's one thing, fine, you have the silver bugs or the people worried about inflation when they buy, but when you get away from, now it doesn't matter about sound money or whether people like silver. Now there's money on the table. There's blood in the water. And even if the price got hammered $2 or $3 tomorrow, because people understand why now, there's been the secret that this was always based on has been exposed. I don't see how that can be put back in. I think if you saw the price smash tomorrow, that probably would end it, because I think people would buy so much metal because they know it, and they would call. Basically, the banks have been bluffing, and now it's getting called. And I don't know which day it will happen or which day it will break loose, but I don't know. Maybe I'll see it differently tomorrow. As of today, I don't see how this is reversed.
Well, we have a question from, can you take a question? We've only got you. Actually, we don't have you. You're 4 minutes over right now. You have a few minutes for questions?
Got till 45 today for you, Will.
All right, perfect. This is from Jake, and he's asking, are silver futures markets predominantly sellers looking to lock in? They're like miners looking to lock in, or are they just tons of speculators? And do you know the split between actual people hedging silver positions and what is speculators in the futures market?
Yeah, it's a great question. I know sometimes people say, these short positions hedged. I mean, there's some room for debate. I guess there was one fella I talked with who was disputing that there's a large short position because the banks get silver from the refinery or the miner, so they're holding silver. So before they send it to their end user, yeah, I could see a case to be made for hedging there. Now, at the same time, is the end user hedging his position, which would theoretically offset the bank's hedge. Someone is short somewhere. There's two sides to these contracts. So someone is short, and I guess here's the thing is that you can look at the COT report that claims the 4 largest traders are short whatever percent of the open interest, which backs out to 292 million ounces of silver. So if there's no offsetting hedge, or whether it's theirs or whether somebody is net short that metal, which somebody I would think has to be, then that means for every dollar silver goes up, they're sharing a $292 billion loss. Silver goes up $3, that's $900 million loss.
What's interesting? That chart that you showed us, for the last 10 years, it looked like the supply and demand has been pretty stable. It doesn't really fluctuate. We haven't seen any really big disruption in that. Like, what do you think the capacity is for these miners to increase production? Let's say that we needed 10, what if the demand went up by 10%? What if that happened? Do they have that capacity just to switch it on? Like Saudi Arabia, just when we need more oil, they just pump it out. How does it work in the silver industry?
Great question, Dimitri. I think everybody's watching is going to love the answer, because fortunately enough, I had Brad Cook of Endeavor Silver. It's a great silver company that I'm a fan of. And he came on my show a couple weeks ago, and he's actually part of the Silver Institute. And he actually discussed that because I don't remember their production numbers. I think First Majestic Silver, it's between like 20 to 30 million ounces a year that they produce. And they're one of the biggest ones. I mean, now there's some projects that get turned on at a higher price, but I guess the way Brad phrased it is that, maybe the silver companies get a few new projects, expedite some things, you get 20 or 30 million extra ounces. I guess the short answer is no, it doesn't move the needle. And in fact, Brad mentioned this. A lot of the folks I've spoken with mentioned this, is that they all expected that the net driver in price comes down to investment demand. Because like you point out, these numbers are pretty stable. Now, I would say that over time and all the projections, especially in a more electronic green world, everyone seems, what is it, California last year now, solar panels on every house. So I think I've not yet heard anyone make the case of the demand outside of economic forces perhaps going down. So no, you can't just, even if the miners try and crank it up, I think Brad's exact words were it barely moves the needle.
Right,
Which
because
means
they're
it's
too
great for the
small
miners,
to-
but if you need silver,
right,
it's going to be hard to come by. Because you had that's why I pointed out here, really what was available was 32 million ounces. So this is pretty static. My feeling, and when I study the numbers, was always this seemed like pretty tight. So when you pop in 350 here, and then now you get 50, you got a seventh of that in 2 days. So hopefully that puts it in perspective.
Well, actually, there are quite a few comments on the chat about how hard it is to ramp up production at mines. It's not just like digging more holes, right? It's a big undertaking. We did have a question, D. I don't know if you're able to share your screen, but someone Chris had mentioned the skew or the surface. Someone was asking within the Market Chameleon website, is there a place to see that? Can you share that?
Yeah, I mean, this is, I was just on First Majestic before we started the show.
All right.
So I'm just looking at, here, and you could see here, this is, I think I went here, let me just go out to something like in March, or let's go out till April. And when we talk about the skew, we're talking about the relative, I'm in March now. We're talking about the relative premium of the strikes, right, versus each other. So we could see here, this is 33 days out. These are the different strikes here. So the top strike, 35 strike. So you see here implied volatility 189. And I think we closed around 22 versus 162. So you see that as it's going up, as we're going up in strikes, the implied volatility is going up, which is, what this is telling us, what this is indicating is that investors believe if we go up, we're not going up slowly. It's going to accelerate. That's what they're saying. That just like on the downside, sometimes when the market goes down, it accelerates to the downside because of leverage. People have to deleverage. When we see a skew to the upside, like we are seeing it right here, that's the market indicating that they believe if we continue going up, that it's going to accelerate and go up at a faster clip. So that's just really quickly. Now, this is in First Majestic. Let's take a look at in SLV.
Now, while he's doing that, Chris, someone did ask, was SLV your only silver play? And I know D was on First Majestic because we were talking about it earlier in the day ourselves. You've mentioned First Majestic numerous times as well. SLV is not the only way you'd play silver. You've actually mentioned that the miners may have more, maybe, upside than actually the SLV. Correct me if I'm wrong, but I think you've mentioned something like that.
Yeah, in fact, I rarely use SLV myself because the flaw to me is that in the outcome that I most expect, where someday people are going to say, hey, I want my metal, and then it's like, hey, we don't have that. To me, there's some risk. So if I put my trade on an SLV and there's an issue there, then it's you were right in the exact situation you bet for, but you're going to lose on your bet, or at least conceivably lose on your bet. And it's a risk that I hedge out. Dimitri, actually, could you pull up the AG board again, please?
Yeah. And just another thing before I move, I'm just showing you, I opened up the open interest here, and you could see there's lots of open interest, even going up to the 41 strike, which is the higher strike. And you could see the amount of options just trading. These are 53% away. We're talking about options, 52 days to go, 53% out of the money. You see lots of volume, lots of open interest. But let's go back to AG.
Will, to touch on your question, yeah, I think there's more upside in the miners. you would expect leverage in the miners. Simple example of that is, I guess I could update my numbers now, but from a few years ago, I used, let's just say, imagine the cost, silver was $15, cost a miner $14 to get it out of the ground. So the margin is $1, right? Make sense?
Yeah.
So if silver goes from 15 to 20, that's a 33% move. But the miner, their profit margin went from $1 to $6. So you see where you're getting the leverage on that?
Right. Yep. So you're getting the leverage in the stock itself.
Right, which is what a lot of people like about them, and it's great. But what people don't like is that it's not as correlated as logic might suggest. So amazingly, First Majestic last year was trading lower when silver was $27 than when silver was $18.
You mentioned that on the previous show, actually.
And as you know, now there's a lot of attention being placed on the short position. So it's kind of like a short position stacked on top of a short position, which is on one hand incredibly glorious, although the risk to that is during that move from 18 to 27, I didn't have anything on SLV. My option trades were on the miners. So I watched silver go, but I watched my options expire worthless. Now, the way I look at it is that if I structure my bet size so that I don't care on any individual occasion, whether I win or lose, because I know the math is in my favor, if I'm correct and it is a short squeeze stacked on top of a leveraged short squeeze, then when I do hit it, if I hit it, which I hope to, and then possibly we're in the process of, First Majestic was it's up $10 in the last week, I think.
So here's a chart just showing what you guys, when it really accelerates up, this is the leverage bet. There's SLV versus AG, where you see the big spike in the stock. Is that what you're referring to?
Yeah. So, I mean, I think there's going to be a day where silver will move, but First Majestic will absolutely soar. And I mean, now it's interesting. You have the Reddit short squeeze or whatever you call the media conglomerate that it's morphed into now, talking about silver and First Majestic. So there's a lot of attention. And I don't know, what if... Dimitri, I have to get going in a minute here, but if you guys continue, or we could think about it and we can discuss next time.
Sure.
Well, what do you can you pull up the price chart of First Majestic and look at what it was the price a week ago? We get
let's do 5 days ago.
Yeah.
Look over here. Oh, you mean the actual price?
Yeah, not the percentage.
Here, I'll just look at the history. But you have given me an idea just from this discussion. But you could see here, $13, $14, $20.
Don't give that idea. We'll talk about it on our morning show tomorrow, D. Chris is his publicist is texting me right now. He's due on I don't know, CNBC or CBS or I don't know. All the big networks are looking.
Well, Will, let me just leave you with this. We saw GameStop go from, I think it was $18 a couple of weeks ago to 500. So my parting thought for anyone watching, not saying this will happen, and by all means do not take this as legal financial advice. GameStop was 18, First Majestic was 13, and you have any of these options on the board on, and First Majestic were to follow a similar trajectory, fun to calculate what those numbers come out like, which again, maybe trading this and doing it responsibly and in a way that is within people's means is the fun part. But I think it's going to be an incredibly exciting situation. And with that said, thank you guys so much for having me. You can find me at arcadiaeconomics.com and on YouTube. And I will look forward to hopefully catching up with you again soon.
Hey,
thanks, Chris. Really appreciate you coming on today. It was really good.
Great, fellas.
Great
I
job.
appreciate what you do. I love this site that you've built. That's what I use myself. And on top of it, which is even far more important, it's really been a pleasure getting to know and become friends with both of you guys the last couple of years. And it's great that people who are looking for a good option education have a place to go and honored to be a part of that and help in any way I can.
Awesome, Chris. Listen, we have a show every morning, 9 a.m. live if you ever want to come on, but maybe we can get you on sooner than later.
Cool. Let's do it sometime soon. If you need me this week, if things get wild, we'll be there.
Awesome. Thanks, buddy. Have a good night. See you in the morning, everyone.
Take it easy.
Thanks.